which sounds absolutely dreadful.
Yes.
But it is better than the previous month, because the previous month was the smallest on record. It kind of tells you where we're at.
This goes, though, to the idea that it's still a tight labor market, so they still have to pay up for labor. Inflation is still hot, and people have less money to spend, especially on the lower ends where they've got less discretionary spending. You put that together, smaller businesses are going to be struggling a bit more.
Equity futures struggling just a little bit more here this morning. We're negative by 0.4%. Let's go through the price action for you. That's the S&P 500. On the NASDAQ, we're negative by 0.45%. Yesterday, really struggled to put together a day of gains. The banks really faded. Just to get you up to speed on PacWest this morning, negative in the pre-market, back down to about 530. Bear in mind, last Monday, 2 Mondays ago, this opened up as a double-digit name, $10. Got hammered last week, tried to make a comeback Friday into Monday morning. Their stories faded pretty quickly. Into the bond market, 2-year, 10-year, 30-year, going into CPI tomorrow. PPI the day after. Your 2-year still just short of 4%, down 2 or 3 basis points this morning, 397.22. On the 10-year maturity, we're down about 2 or 3 basis points to 348. In the FX market, off the back of some pretty weak data out of China, you get some euro weakness. Euro dollar, a breaker 110 for the euro against the dollar, 109.80. We're negative 0.2%. Before we get to CPI and PPI, we've got to deal with this. President Biden and congressional leaders meeting at 4 p.m. this afternoon to try and break the partisan deadlock on the debt limit. Senator Mitch McConnell warning he won't come to Biden's rescue, saying this: they're assuming there's some secret little plan. The White House and the Speaker's teams need to sit down now and settle it. Joining us is Heidi Krivo-Redeker, Senior Fellow at the Council on Foreign Relations. Heidi, is there some secret little plan, and do you have it with us this morning?
Yeah, I come bearing the secret plan. I think consistent with what many of your speakers have been talking about, this meeting today is really, the best outcome is that they continue to talk and negotiate and open some, a little bit of daylight in the ability to carry on. Where this goes, there is no secret plan, and I think the most important thing that markets need to understand is that this is we're in uncharted territory right now, because when we've had these standoffs in the past, we haven't had such a polarized Congress and polarized politics. We haven't had such a narrow majority in the House, and we haven't had a speaker who's made a deal that we don't really know how much negotiating power he has. But he did just pass. He did just pass a bill, and it gives him leverage. So there is no secret plan. I expect after this meeting today, everyone's going to take to raw politics, going out to constituencies, whether it's business constituencies, whether it is going after fragile red states where you have veterans, fentanyl, Social Security checks. You're going to have a full blast on media about what's at risk here. And I don't think that the Republicans are necessarily going to budge. I don't think McCarthy has a lot of room to budge. So there is no secret plan.
So when you said markets need to understand, there is a question about whether markets are being held hostage by this negotiation, that basically, as we heard from Dalip Singh yesterday of PGIM fixed income, essentially politicians are waiting for markets to freak out, for the S&P to tank before they go to their constituents and say, we had no choice. Is that really what's going to basically have to happen before there's a deal?
So I think I would agree with Dalip that there needs to be market pressure. There needs to be something, and we already have. I mean, it's unfortunate that that's what we're looking to pressure politicians. But without that market signal, it makes it hard for McCarthy to go to the holdouts who are holding him hostage and say it is time to do a temporary lift of the debt ceiling to get us through and get us a little bit of space to negotiate between, so that nobody loses face at the end of this.
This is incredibly difficult because if the politicians are waiting for markets to respond, markets are thinking, we've been through this before, and we're just going to lose our shirts. We're going to lose money and be on the wrong end of this if we play into this game of chicken, as John put it earlier, that Washington is playing with markets. So at what point is this just becoming circular before markets don't respond, and then there is no deal? It actually makes it more likely that we get some sort of default.
So the fact that we're talking in Washington about needing markets, and markets are and Wall Street's looking at Washington saying, you guys got to do your job. It shows you what a gap there is between DC and New York, and it means that we have it means that the system is obviously broken. It also means that we're putting out this picture on the world stage of the United States as being hugely dysfunctional and not a leader and steward of global markets and the global economy. The pressure needs to come, and whether it comes from outreach to constituents and particularly in fragile states or from markets, we need to have the pressure that gets us to a relief period so you can align budget negotiations and debt ceiling negotiations so that everyone can walk away with some face saving at the end of this. And we hope we get there. It's more likely to be in the fall than over the summer. But in the meantime, you're going to have a lot of politics playing out, and that is bad for it'll give you a lot to talk about.
We'd rather not talk about this, Heidi.
The story's not going to end just today after this meeting.
Heidi, you alluded to something really important. Whether this compromises the United States on the international stage going into the G7, do you think that's the case?
I think we have we lose credibility. We go in with a desire to project power, to project the strength of the dollar as the central reserve currency of the world that we use, underpins our sanctions, our economic statecraft. We have the deepest, most liquid capital markets in the world. We have, I don't think we actually even have a threat to the dollar that is out there right now, except from our own doing. Our own, it's an own goal from every way you look at it. So Janet Yellen is coming, her G7 meeting is cut short. We have Biden heading out to a G7 and Quad meeting at the leaders level later this month. This will all be background music to a president that wants to go out and talk about leadership, stewardship, responsibility. And at home, we're going to have this political morass of debt ceiling negotiations.
For a long, long time, the US had the luxury of doing questionable things. How do you think that luxury is no longer there?
So I think that this, our friends are watching us very closely. We're heading into a presidential election cycle. So our friends are watching us closely, but we're literally playing into the hands of our foes. Those who would be, we're handing the talking points to adversaries right now about the U.S. is losing its ability to lead the global economy, to lead the global alliances, and it's just the timing is very bad. It's at a time when we are really trying to reassert that leadership, and we're not showing it at home.
Heidi, appreciate your time. Let's catch up soon. Wonderful input and insight, as always, from Heidi Kriber-Rediker of the Council on Foreign Relations. For a long, long time, politicians in the US have had the luxury of doing silly things because markets ultimately forgive them, because the Treasury market is such a different beast, Lisa, compared to the rest of the world, as we know.
And you've raised this question in the past when we've had debt ceiling questions. People have piled into Treasuries in this perversity that basically yields go lower. And it's the opposite of what you'd expect if actually the credit rating or the credit perspective seems to deteriorate. Does this time change? Is this time different with respect to people's willingness to buy Treasuries? I don't know. I'm not sold on this. I don't know what to think.
That's the ultimate stress test for me. Speak to a fixed income strategist, investor. We'll catch up with Robert Tipper PGIM, I think, in about 50 minutes' time. Ask him, if things get messy in the next month, will you buy Treasuries? And if he says, yes, I will buy Treasuries, then we've answered the question, haven't we? They have the luxury still of doing silly things down in D.C.
Well, yes, although people talk about the longer-term implications, which could potentially hamper the dollar's supremacy and a whole host of other issues, and whether, the U.S. loses clout negotiating. But yeah, I agree with you. I think that there's a bigger stress test.
I feel like we've done that conversation how many times over the last 10, 20 years?
We could keep having it.
True. No, I agree. We should keep having it. Just,
That hasn't stopped us before from having a conversation
at some
repeatedly.
point it's different.
Correct.
At some point it's different, and ultimately every time we have this debate, that's the question we ask: is it different this time? Robert Sipper, PGIM, coming up in the next hour. Looking forward to that. Equity futures negative here by 0.4% from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says that if Congress fails to raise a debt ceiling, it would have an adverse impact on the use of the dollar worldwide and would be an economic catastrophe for the nation. She told CNBC that the government would also need to figure out, quote, what to do with the resources that we do have. President Biden is meeting with congressional leaders today about the debt ceiling. The public's not showing much confidence in Federal Reserve Chair Jerome Powell. According to a new Gallup poll, 36% of U.S. adults say they have a great deal or a fair amount of confidence that Powell would do or recommend the right thing for the economy. That's the lowest level recorded since Gallup began tracking public confidence in the Fed chair in 2001. In Pakistan, former Prime Minister Imran Khan has been detained. The former cricket star faces a number of court cases and was set to be formally indicted on Wednesday. That has to do with the allegations that he did not properly disclose earnings from the sale of state gifts from his time in office. Khan has called for early elections next year after getting ousted in April 2022 in a no-confidence vote. Goldman Sachs will pay $215 million to settle a long-running class action lawsuit on underpaying women. The case involved about 2,800 female associates and vice presidents. It was closely watched in an industry where women have long said that complaining of unfair treatment can derail careers. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. We're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
there's a dangerous shortage of growth outside China, and even it is feeling it from the rest of the world. That's in large part because investment isn't going into the right places. You have basically a misallocation of capital where it goes into a narrower and narrower group of governments in the advanced economies.
That was David Malpass, the World Bank Group president, weighing in on the situation with global growth at the moment. That line there, the dangerous shortage of growth outside China. There might be a shortage of growth inside China. The latest data on the trade front not encouraging, particularly import growth. Absolutely plunging. The broader market this morning, negative 0.3% on the S&P 500. Yields on a 10-year look a little something like this on a 10-year at the moment, lower by a couple of basis points. 3.48 on a 10-year. Right now, looking at crude, negative 0.9%, 72.52 on crude at the moment. Bank of America had a triple-digit crude forecast. That got cut in February to 88. Just moments ago, cut again. They've cut their 23 forecast, Lisa, for Brent crude to $80 a barrel on what? A weaker outlook for global demand.
What the issue for me is, we're not actually hearing that. We're seeing that in the data, the underlying demand issues. I mean, take a look, for example, at all the people flying around the world. Take a look at all the people who are driving around. There isn't necessarily this massive decline in demand, and you're seeing that borne out in numbers. So is this an expected decline in economic activity that hasn't transpired? Or are people downgrading their expectations for crude because of the actuality of a lack of demand, particularly from China? I am not clear on this point.
Let's get to the quote. Here it is. The first order effect of reduced credit and further interest rate hikes is weaker demand. Will Kennedy joins us now, Bloomberg Senior Executive Editor for Energy and Commodities. Will, can we pick up on Lisa's question? And Will, great to see you, buddy, as always. Will, do you think this is about what we might see further down the road, or are you seeing a softening of demand right here, right now?
Lisa's point is a good one. We haven't seen any huge softening in demand as we look around the world. The point about planes is well made. Gasoline demand is strong in many parts of the world, and Chinese demand has picked up. I think there are a couple of things going on. I think there is concern about the economic outlook in the year ahead and whether demand growth will be as strong as people expected. There has been some weakness in diesel demand, which is an indicator that the industrial economy may not be firing on all cylinders. And finally, I think people talk a lot about demand, but we should also look at supply. Yes, we've had that OPEC cut, but it hasn't been fully implemented yet. And there's still little sign that Russia is following through on its pledge to cut 500,000 barrels a day. Meanwhile, the American shale industry still grows, albeit more slowly in the past. We get new oil from parts of South America like Guyana and Brazil. And when you put those two things together, the supply-demand picture does not look quite as tight as it perhaps did a few months ago. That said, there are lots of analysts out there who say it will tighten in the second half of the year, and this market looks oversold, but we'll see.
What do you think is driving that oversold? Is this basically a macro bet that people are using in macro hedge funds to make some sort of statement on future declines in growth that people in the physical market don't understand? Is that kind of the narrative that you keep hearing?
That does seem to be what a lot of people are saying. I mean, clearly last year a lot of macro investors used oil as a way to bet on inflation, and I think now people are using the same trade to bet on a slowdown, and that creates flows which aren't necessarily related to the real world supply and demand of crude oil, but more to people's expectations of the economy. And I think there's certainly some of that going on when we look at the data. That said, a lot of those people, it does seem that the positioning has changed and that maybe there is room for some upside from here.
Well, how fragile, and just to sort of build on that point, how fragile is market positioning right now based on the fact that a lack of credit actually means that production will be less going forward? This is a point that we've heard from JP Morgan in particular. Basically, think of the shale patch. They're not going to be producing more. A lot of oil majors are going to say, look at prices where they are. Why should we invest on producing more? And that will mean a tighter market later on.
I think that's exactly right. When you look at the fundamental picture for crude oil in the years ahead, be it second half of this year or into next year, clearly you have a picture where demand is expected to increase. We don't know how fast it will increase. It's always worth making the point that recessions tend to trim supply growth, but they very rarely, outside the global financial crisis or COVID, actually lead to a drop in total demand, just a weaker growth in demand. And at the same time, supply is constrained for all the reasons that you mentioned. People aren't investing as much in oil production as they used to. So the fundamentals do on the surface look quite strong, but clearly in the recent months something is not quite right in that transmission mechanism that many people expected to see. I mean, it's worth pointing out, Lisa, that a lot of people have been caught, as you were saying at the top of the item with Bank of America, a lot of people have been caught wrong-footed by this oil market this year.
Well, are the Saudis happy with $76 Brent?
Well, the Saudis do not talk about prices. They do not target a price. It's always worth saying. So you won't get them to say they're unhappy. I think that the recent production cut that we saw from OPEC in April shows that they are not happy at price levels and current price levels. And clearly they got a bit of a boost and it's fallen all the way back to where it was. We see today in the Aramco news that they're looking to take more dividends out of Aramco and funnel it towards the state. And the Saudi budget deficit has edged into deficit on these weaker prices. I think the common consensus for people who look at Saudi is that really to achieve the economic things that they want to do, they're more comfortable with getting prices closer to $100 a barrel, and they're clearly some way away from that. So while you won't hear them talk about a price, I think it's reasonable to infer that they probably aren't happy with oil in the 70s.
Hey, Will, great to get your perspective as always. Will Kennedy out of London on the crude market. I think it's fair to say they're not happy with the 70s.
Yeah.
So what next?
Well, so do they just simply cut production even more, leading to an even tighter market? Or is this something where they basically want to allow this to play out, shake out all the potential competitors who are getting lower prices and then come in, you know?
Didn't they try that before?
Yeah. They did try that before. I don't know, but if they do cut even more, that even speaks to the tightness in the market later on that people are talking about even more.
Crude right now 72. If you are just tuning in, the latest move from B of A, the team at Bank of America, led by Francisco Blanche, looking at this now, a 23 forecast, so year-end this year for Brent, of $80 a barrel on a weaker outlook for global demand. This is their quote: the first order effect of reduced credit and further interest rate hikes is weaker demand. So this is for year-end. Year-end was 100. It came down to 88. Then the targets come down to 80. So a pretty clear direction of travel there, Lisa, into year-end for them.
I'm distracted right now, and I'll tell you why.
What by?
Because I'm hearing these things about the oil market, and then I read a story in the past couple of days about how airfares are rising at more than twice the rate of inflation, and you can't get tickets to a lot of the places that you want to go to. Double-digit increases in the cost of airplane tickets for many consecutive months.
And no pushback.
And no pushback.
No.
And so you think about this kind of demand, you square that and all of the vacation time, and how about consumer discretionaries and Airbnb, like all of these things that are like coming out. And then people are like, oh, but demand's going down and we're going to really struggle. I'm just struggling to square these things.
Consumer price tolerance is just absolutely incredible on this front. There's been no pushback. It's amazing.
I'm waiting for the pushback. I want the pushback because it's absolutely ridiculous. And yet, you know, if you want to fly, you still pay it.
Particularly on international travel. JP Morgan came out with a note yesterday, I think it was them, that upgraded the likes of the big players, American Airlines and those kind of people, because of the international travel component to those companies. The smaller airlines, the domestic front-facing ones, less enthusiastic about them. I think that's pretty interesting. International travel is nuts. TK sits there. You know when you and I are having a conversation and he looks distracted?
Yeah,
he's looking at flight prices.
I know, actually, sometimes he does.
All the time.
Yeah.
Just trying to gauge how much things are. They are increasingly expensive and there is no pushback as far as I can see.
Maybe that's why I was distracted by flight prices while I
Sure.
was sitting in this
Well,
chair.
you're in TKC because it's got it preloaded.
Exactly. So it's basically, you know, it is pretty distracting. But, you know, I wonder how much this is business, how much this is business travel, and how much this is actually vacation. And I wonder how much you're going to end up seeing these cabins just become, you know, most of it being business class.
It's happening.
I know. And then everybody else kind of sardines in the back, forced to pay more, experience less.
We're diversified. TK looks at United, you look at Delta, and complain about it often. I try and look at American. See what's happening, just to balance things out. I'm all about balance.
We
balance.
represent a lot of things. Did you see Biden yesterday talking about how he was going to make airlines pay for
I didn't watch it. Do you want to share with us all? What did he have to say?
I mean, just refunds for delayed or canceled flights, hotels, etc.
Totally on board with that. Great.
Mean, sure.
More of that stuff.
Yeah, exactly. I think it was like obviously catering to everybody's frustration with the experience.
I think there is an inverse correlation between how well airlines are doing and how we feel about airlines. I think that's always the case. If airlines are doing well, you can just chart the stock price. I think you can get a decent feel for what the experience is like at the moment.
Wasn't that Alitalia's problem? The experience was amazing.
Alitalia's amazing.
Right, but...
called Air Ita now. You ever fly Alitalia, honestly? Wow. What a menu. Just amazing.
That's exactly... How are they doing profitability-wise?
Well, I've got no idea, but they did go bankrupt, right?
There you go.
They've had some trouble. For good reason, because the food is so good.
Can I fly there?
The margins on the food must be tiny. Then you go to these other airlines and you eat that stuff. Wow.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
And you're one of the most fascinating entrepreneurs because you also started really young. What did you learn? Did you always think that you'd be an entrepreneur?
Probably, yes. I think, which is a bit sad,
From
isn't it?
age, what, 5,
Well,
6?
maybe, I'm not sure. I come from a family of entrepreneurs, so even though I probably can spell the word and still can't occasionally, it's sort of in my blood. But it's really fun starting a business. And fun growing a business. I feel it's a real privilege. And I started my business officially at 18, but I think I knew I wanted to do it very differently from about 15. But I'm sure it's, if you're surrounded by it, it feels very natural. So yes, it's fun.
And it started how? You started by you went to Florence. It was in Italy, and you started handbags.
Yeah, so I knew I was actually given a handbag by my mother when I was about 16, one of her old handbags, and I remember how it made me feel, and I think fashion is fascinating for the mood-changing, the confidence-boosting aspects, of the sort of tribal aspects of what fashion does. And so I went at 18 to Florence, knowing that was the home of leather goods, which is what interested me. I just wanted to learn, actually, and be surrounded by craftsmen who are making things as important, and that's going to be very interesting, I think, over the next sort of 10 years. I think the onshoring of craft and manufacturing is going to be fascinating, actually. I mean, I watched the offshoring. I literally saw it, and I think we're going to be seeing that coming back to local. We have to. When we're all looking at our objectives in terms of carbon, proximity is going to be key.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're in this very broken play, a world of a series of not just serious, but quite unique and rather unprecedented disruptions.
I don't think we necessarily set a new low, but we could arguably retest those existing lows at some time before the end of the year.
Right now, we have 5 cuts priced into Fed fund futures over the next 12 months. That's a lot.
The market is underpricing the risk of the Fed remaining on hold for the remainder of the year.
Unfortunately, I think a mild recession is the most likely outcome.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Alongside Lisa Bramford, I'm Jonathan Ferro. Your equity market on the S&P 500 negative by 0.3%. No drama there. If you want some drama, look to the regionals. PacWest is down and down hard in the pre-market, trading at about $5 a share. Last Monday, a week ago, double-digit name breaking down again this morning and struggling to squeeze out a day of gains in yesterday's session off the back of the SLOOS, the Senior Loan Officer Opinion Survey, which we apparently are obsessed with now, Bramo.
Yeah, and actually Bloomberg Intelligence came out and said that even though a lot of people said it didn't show that much tightening and the sleuths weren't exactly incredibly revealing, they did show that even though companies weren't tightening as much as some expected, very few of them were expecting to increase their loans or loosen their conditions. So they think that actually this was a more bearish or tighter kind of credit report than many people are giving credit to.
Little mini crises everywhere. I remember Mohamed Al-Erin talked about that about 18 months ago. He said all these little fires just coming up everywhere. Banking's one thing. Here's one that we've started ourselves. The arsonists down in Washington, D.C. The debt ceiling drama later on. I think we can call them that, right?
Sure.
We just did. 4 p.m. Eastern time in the Oval Office, congressional leadership sitting down with the President of the United States, Democratic leader Hakeem Jeffries, Senate Majority Leader Chuck Schumer, Mitch McConnell's going to be there, all fun and games. We're going to sort anything out later this afternoon?
No, I mean, they basically said that we're not going to sort anything out. Don't expect anything. This isn't going to be a silver bullet. People are going to be looking for some sort of wiggle room with negotiating on either side, how much Kevin McCarthy actually has a hold over the Republican Party. Same with the Democrats. My question just goes back to what we were talking about in the last hour, is the game of chicken, as you called it. And I'm very concerned about this idea that Wall Street's seen this before. They're not going to move. Why should they lose money on something that's basically a game for Washington to be able to go back to constituents and saying, look, we had no choice? At the same time, without that, are they not going to get a deal done? And this is a really big problem, to my opinion.
Playing chicken with the S&P 500. That's going to be the game that we're all playing over the next month or so. And right now, we're not seeing a big break on the S&P 500. The overwhelming consensus right now is this equity market wants its rate cuts and its growth too. And you can't have both.
And part of this is because there has been this game of chicken with all of the economists calling for recession for so many months that hasn't happened, and better than expected results. And all of a sudden, what do you end up happening is a market that doesn't want to budge. It's just basically sick of the game of chicken to try to price something in.
I think it's amazing to see Mike Wilson and Marko Kolanovic still on the same page. Still trying to get my head around that after last year where Marko was so bullish and Mike was so bearish. And then seemingly this year, they're both bearish, and they're saying essentially the same thing. Mike Wilson, Morgan Stanley, started the week. He said equities are priced for an optimistic and low probability outcome. Marko Kolanovic said this over at JP Morgan: equity markets and the Fed and the gap between them and the bond market likely to close at the expense of equities. And that's the issue at the moment. Can you really price, and this is what Mike was talking about, both rate cuts and durable growth? Can you have your rate cuts and your growth too? No.
The only way that you could have that is if you have immaculate disinflation. And the data, and what we will get tomorrow with CPI, will probably highlight you cannot. At least that's not what we're seeing. We're getting sticky inflation in a number of different metrics. So then when does it get reconciled in markets that still want to go up?
Let's talk about the market right now. Going down just a little bit, negative 0.4% on the S&P 500. In the bond market, shaping up as follows. Yields a bit lower here, Lisa, no drama. Down a couple of basis points. Your 10-year, a break of 350 at 348.24.
It's been an exhausting market. Honestly, I said that about 15 times yesterday. I said I wasn't going to say it today, and yet here I am saying it again. We get, of course, that meeting today. Earlier, we do get a host of Fed speak, including at 8:30 a.m. from Fed Governor Philip Jefferson, New York Fed President speaking later on, John Williams. How they talk about reconciling this gap will be interesting to me. That meeting does happen at 4 p.m., as John was mentioning. President Biden meeting with Republican leaders as well as Democratic leaders. How much do we get? Some signs that there are areas where they can come to some agreement, what the potential resolution could be, and really how much they really are looking to the S&P to force their hand, or whether there are some other tools they're going to use. And today, earnings continue 85% the way through this earnings season. I'm particularly interested in some of the consumer discretionaries, Airbnb, for example, Wynn Resorts, both of those shares surging so far this year, up more than 47% for Airbnb and 37% for Wynn Resorts. This increase in consumer discretionary spending is really one of the biggest question marks, in my opinion, given the fact that we see consumers still very much willing to spend, yet everyone's bearish on how the economy is going to do, the economy that hinges 70% on consumer discretionary spending or consumer spending in general. So trying to square this is really difficult and part of the frustrating aspect of this year.
It's still a high nominal growth world. I can sense you're frustrated.
Well,
you didn't need to tell us. You could just tell. This is what Savita Subramaniam said over at Bank of America. Q1 is tracking a 5% EPS beat. Surprise ratios are well above average. Guidance is strong. That's the takeaway from B of A.
Of course, on a very low base, but this is the truth, right? They're still doing okay. And you've seen a lack of confidence by corporate executives that isn't reflected by a lack of confidence in consumers who keep spending and now keep borrowing even more than companies.
And joining us now is Katie Kaminsky, Chief Research Strategist at Alpha Simplex. Katie, wonderful to have you with us on the program. Can this market have its rate cuts and its growth too?
No, not at the same time. I think part of the reason we have a challenge right now is the equity market is way ahead of itself. And I would say that we have to follow the bond market and follow inflation. And this is why everyone's sort of treading water to figure out how quick is inflation going to go down. If inflation continues to go up, we need to watch the bond market because long-term cash flows dislike inflation a lot. So it's really going to be a question of, does the bond market go first and then does the equity market follow? And so I think we're much more concerned about bond markets than we are about the equity markets. We think we'll follow later.
So, Katie, are you still short treasuries?
Yes, the view is still short treasuries. I know a lot of people would say that March kind of definitely made that positioning challenged, but what we do see over medium to long-term horizons, given the long-term trend in fixed income, we've been in about a 3-year bear market for fixed income. We've consolidated for 6 months. Honestly, if inflation stays sticky, inflation is the bane of bonds' existence. So we could see a steepener if people realize that long-term cash flows will be affected by higher inflation for longer, and a Fed that's on pause. Really, if we do actually have rate cuts, it would only be under a very bad scenario. So to me, that looks like not a very positive sign longer term for equities, as well as short term with mild inflation is okay.
Bearish on bonds. Is this bearish on longer term bonds or bearish on short term bonds, especially given some of the fluctuations and distortions we're seeing on the short end?
Well, I'd say it's been trickier on the short end. I'm much more bearish on longer term bonds because if you think about a scenario with higher inflation, holding long term cash flows is not an ideal scenario. And so I'd say that really it's more medium term on the center of the curve that would be interesting. Shorter term bonds are really, they've taken a lot of the moves if you think about how far they've come. So from our perspective, there's probably more movement available on the longer end of the curve.
We've been talking all morning about the debt ceiling issues and sort of what happens for investors as we get closer to that deadline. The real test we were talking about earlier will be whether people continue to buy treasuries if there is some sort of stress or concern about a default of the U.S. Would you think, or would you become less bearish on bonds if the U.S. does approach that deadline?
Well, think about it this way. I mean, I think the challenge with treasuries is all of this has created this massive unrelated risk. So you now have this massive risk that has nothing to do with the financial conditions, that has everything to do with politics. And I think why people are waiting, as I think, Lisa, you put it perfectly, is that we need to see consolidation of the trend. We need to see where the market goes as a result of this, because it's really, really unclear for us to determine what the ramifications of challenges with the debt ceiling really mean. It's very complex at this point. So I think we're all waiting to see what happens.
Just to drill down on that, though, Katie, to pick up on what Lisa's been talking about, do you believe this is still a buy treasury moment, or is it different this time?
That's a good question. I mean, I think the challenge is why people were so bullish on treasuries was because they were concerned about the safety of their deposits. And it's really about following the money flow. And if people are nervous and they think that the U.S. Is not going to default, or there's not going to be any sort of challenges in the treasury markets, I can see that those have generally been the risk, the asset to choose in a safe haven environment. But if you look at some of these other assets like gold and platinum, they've really moved in this environment, which indicates that people are just not sure what a safe haven asset is under these conditions.
Well, Katie, I asked this specifically because you are short treasuries, and I wonder how painful that might be if we get to this situation where we carry on playing chicken with the S&P 500, things going in the wrong direction, and the playbook of the last decade, every time this happens, you buy treasuries. That's going to put an awful squeeze on you, Katie. I just wonder where you and the team have come down on that.
Well, to be honest with you, the signals in treasuries are very mild. And I think that's what you see across the board, that net, the view on treasuries is mildly short. So it's not anywhere in the same ballpark of the type of signals that you saw last year. And I think what that indicates is this is sort of tentatively the direction is weakness in bonds, but because of all the volatility and all the noise, that's not an extremely strong signal at this point. So I would actually consider that trends are in consolidation, waiting for the next big evidence that something is actually changing that could be a bear market for bonds. Or, like you said, we could have a risk off and a recessionary shock that comes earlier than all of the economists are predicting, which is later this year. I think we really need a catalyst. Is the debt ceiling a catalyst? I'm not sure.
Kelly, thank you. Kelly Kaminsky there of Alpha Simplex. Short treasuries, but ultimately struggling to answer that question, Lisa. I think a lot of people are.
Basically, this market, it's like we have no clue. We have no edge. That's basically what everyone's been saying, because how can you predict and get in the heads of, Mitch McConnell, Kevin McCarthy, Chuck Schumer?
You can't.
I mean, honestly, take your pick.
I think getting an edge on a story like this is impossibly difficult, which is why so many people refuse to discuss it in any level of detail. It's just a bunch of scenario analysis. Like it's like a what if, and then what. And I was listening to Secretary Yellen yesterday, who didn't even want to engage in scenario analysis. So
she literally said that.
Like, what use is that?
Well, and at this point,
central bankers drive me nuts. Can I just say that about?
Please.
So they always say things like, "Let's not deal with hypotheticals," and I wish journalists would push back against that, because they spend their whole life, their whole existence at these central banks trying to establish the reaction function. How do you convey the reaction function without discussing hypotheticals?
It's a great question.
And I wish people would just push back against that nonsense. It's like the ultimate cop-out, media training. You're asked a question you don't like about a scenario you don't want to talk about. I don't want to deal with hypotheticals.
But they should say.
But
the better question is...
It's literally your job as a policymaker.
It's a great point.
The prudent thing to do is to do a bunch of scenario analysis. Share it with the public.
It's a great point.
That's the rant over. Lisa Shallett's coming up at Morgan Stanley. She'll take over the rant on this equity market a little bit later. From New York, this is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. Senate Republican leader Mitch McConnell warns he has no secret plan to solve the debt limit deadlock. Congressional leaders meet today with President Biden. McConnell says he told the president it was up to him and House Speaker Kevin McCarthy to find a solution. At the same time, McConnell predicts the two sides will reach a deal and avoid a default. Vladimir Putin vowed to pursue his invasion of Ukraine, accusing the Kremlin's enemies of seeking to dismember Russia. Putin spoke at the start of the annual military parade celebrating the Soviet victory in World War II. He said that a real war has been unleashed against the motherland. Biotech company Novavax has plans to cut about 25% of its global workforce. The Maryland-based firm had a little under 2,000 employees at the end of last year. Novavax was one of the companies that geared up to make COVID vaccines after the coronavirus outbreak. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. Golf's popularity is surging. That's been great for the LPGA. And CFO Kathy Milthorpe is focused on maintaining that drive.
The ability to be able to compete at the highest level and earn purses that are commensurate with their male counterparts is a mission that we're driving towards every day.
Watch Chief Future Officer, Wednesday on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
It has to be done between the president and the House of Representatives and the Republican House of Representatives, the Republican majority. I think a short-term debt ceiling increase would do a little bit of a cooling off period. The president needs to engage in the political reality of McCarthy's ability to lead that House. The president needs to show leadership.
That's the line from Senator Bill Cassidy of Louisiana. Here's the line from Senator Mitch McConnell. They're assuming there's some little secret plan here. I love this. The White House and the Speaker's teams need to sit down now and settle it. There's no secret little plan here.
Yeah, not exactly encouraging. I'm waiting for the spin cycle for where everyone tries to pin the blame and the obstacles on the other party, because essentially, if this is political suicide, it's going to ultimately be a question of who they can pin this on. So I imagine that we will get a lot of, well, they're not willing to budge on this, and they're not willing to budge on this, and that's kind of what I'm expecting.
Looking forward to that this evening. That's going to be great, isn't it?
I can't wait.
Around about 6 p.m. Eastern Time.
Just wait.
Every single news network in the United States of America. It's like the blame tour.
Exactly.
I love the blame tour after a nice meeting. It's going to be great, isn't it?
That's literally the playbook here, is to basically try to pin it on the other party, for the other party to feel like it's politically suicidal for them to go more than the other party. It's almost reliant on that blame game, holding the public hostage, holding markets hostage. God, I love this story.
Holding Bramo hostage. He's already, I mean, literally we're in the foothills of this mess. Like, it's just started. It's just started, and you're already fed up with it. Later on today, 4 p.m. Eastern Time, a meeting in the Oval Office between House Democratic leader Hakeem Jeffries, Senate Majority Leader Chuck Schumer, Republican leader Mitch McConnell, House Speaker Kevin McCarthy, and the President of the United States. And AMA's trying to bang the door down. She joins us now in Washington. Anne-Marie, how important is this meeting later on this afternoon?
It's really just an opening meeting, and you can expect that, given the rhetoric we've seen leading up to it, the red lines maintain for both the White House as well as Republicans in the Senate and in the House. So this is just going to be an opening meeting where I imagine the president is going to tell the Republicans they cannot hold the economy hostage. You heard what Secretary Yellen had to say over the weekend. She says what the Republicans are doing is basically a gun to the economy's head. And then what you're going to hear from Speaker McCarthy, and he's going to be backed up by Senate Minority Leader Mitch McConnell, who said there's no secret plan. He's going to say, in order to get this through my conference, I'm going to need to tie these two together, and I'm going to have fiscal cuts. And then what you guys are touching upon is really the important part. When they come out to the driveway, just behind the North Lawn, outside the Oval Office, this is going to be a battle for the airwaves. Which side is going to be winning in terms of public opinion?
So who is to blame? I mean, what's basically the argument? What are the lines that are being drawn for how they're trying to, frame the spin cycle that we're about to embark in?
Well, Speaker McCarthy has made it clear, he's done that so in 2 interviews with me, that he's been wanting, almost begging the president for a meeting on this. The president has said, show me a budget, show me a plan, and then we can talk. The president says he has no problem discussing spending cuts and fiscal reform, but he does not want to tie it with the debt ceiling. You heard from Karine Jean-Pierre yesterday, the president's press secretary, saying that this is a manufactured crisis, what the Republicans want to do. They continuously talk about how under the Trump administration, there was clean debt raises 3 times, and they want to see that happen again. They do not want to set a precedent. But the thing is, McCarthy cannot get that through his conference. And Jonathan, you brought up what he said about no secret plan, because many thought potentially Mitch McConnell and Joe Biden can hammer this out themselves. They did so in 2011. But then what McConnell said to Steve Dennis in this Bloomberg interview, I think was one of the more important lines, which was, we're in a situation now in the House of Representatives that is much more reluctant to enter into a deal than we had in 2011. And that is at the heart of the problem for Speaker McCarthy. He is not able to get a clean deal through his caucus.
The legal consequences of this are particularly interesting, not least because of the discussion around the 14th Amendment. But U.S. government employees are considering suing the federal government to continue to pay them, to continue to increase and make good on their obligations, because they believe that they are contractually obligated and they're trying to get ahead of a situation like they have been in the past where they didn't get paid for a couple of weeks. Could there be some sort of legal challenge to spending cuts that were already agreed upon by the government?
I'm sure there could be, and if there's the 14th Amendment use, even Secretary Yellen said that would cause a constitutional crisis. You can imagine that that would also invoke some legal issues on the other side, saying that this is illegal to do and the hands of this are in Congress. So this can get very messy. I think one thing is important to note, that we have seen this movie before. Yes, it is different, and McConnell really alluded to that yesterday, but many maintain that none of these individuals, the Big Four or President Biden, want to see a default. So at some point, people still believe there will be a deal, and deals don't get done in Washington until the 11th hour.
The most interesting person in the room is always the quietest person in the room. And I just had a message about Mitch McConnell that I find pretty interesting, to be honest with you, Anne-Marie. Senator McConnell, spoke a little bit, but to be honest with you, hasn't really stuck his neck out, has he, Anne-Marie, in any way, shape or form? Why do you think that might be?
Well, from the beginning, he said this is a negotiation between McCarthy and Biden. He did the last one, but the numbers are different. The House has control under the Republican leadership. He says that he cannot get anything through the Senate that the House Republicans are not able to sign off. So what he's doing is really sitting back and I think seeing as far as negotiations can go between Speaker McCarthy and Joe Biden. And what you really saw over the weekend is Republicans on the Senate side coalescing around Kevin McCarthy. 43 of them wrote this letter saying they will not vote for a clean debt hike. And then, of course, we had Mitch McConnell sitting down with our Steve Dennis saying there's no secret plan here in the Senate. It has to be worked out between the House leadership and the White House.
I'm always interested in how a reporter, correspondent gauges the consensus as it evolves. Do you get the feeling in Washington at the moment, Anne-Marie, that consensus is shifting towards some kind of short-term solution that kicks the can into later this year?
Well, as Mike McKee always quotes, in Washington, when you run out of land, build more land. So this is a potential. We have seen this before. I think one big issue with this is potentially there are going to be these House Republicans who, if there's a short-term agreement, and then obviously they need to have a longer-term agreement, that would be at the end of the year 3 votes on raising the debt ceiling. And for some, that is politically toxic.
AMH, great to catch up. Anne-Marie down in Washington, D.C. It won't get solved until the 11th hour. The problem with all of this, of course, is we don't know what the 11th hour is. We think we've got some idea of where it lands. That X date could be as early as June, could be as late as the end of June. And as a policymaker, you've got to be conservative about these things, right? You've got to come in earlier just to make sure that, you don't hit the date on accident.
Basically, the fact that Janet Yellen said June 1st means that it's probably closer to June 30th is basically what you're saying.
Precisely.
Which is, I think, what markets are kind of counting on, which is the reason why you haven't seen the concern. You asked a great question about Mitch McConnell and how he's been so quiet. And I think about the political liability at a time when the Republican Party is coalescing around former President Trump as the likely candidate to run against President Biden in the next election. And sort of this discomfort and unwillingness to really tread into the morass of the different sides and the polarization within parties that you see on both sides. If they don't have to tread into that, why are they going to?
Why get caught in a mud-slinging fight?
Exactly.
Everyone's going to look stupid. Seems to be the takeaway from the messages I'm receiving this morning.
Which makes perfect sense at a time when you just want to stay clear because there's no winning here. Everyone's going to look pretty bad after this.
How many more months have we got of this?
What's this? Are you talking about the election cycle or are you talking about debt ceiling?
I'm talking about this specifically. This might go another, 6 to 8 weeks, possibly?
I'm still really struggling with this idea that they're waiting for Wall Street to respond. that they're waiting for the S&P to fall before they can take action.
Not new. Do you not remember when President Obama said, basically encouraged the market to respond?
I remember that.
To the mess.
Yeah, I remember that. I also remember, the idea that the Fed was using the market to kind of send a message to also be the transmission mechanism. Is the market now the transmission mechanism for political wrangling in Washington, D.C.? At what point do people get sick of being used as that mechanism, and then that mechanism kind of dampens as a tool?
It's highly irresponsible to play games with financial markets. Highly, highly irresponsible, but if that's the game, I guess that's the game, and we need to pay attention to it. Robert Tipper, PGIM's going to join us shortly. He'll weigh in on this situation in the equity market at the moment on the S&P 500. Near session lows, negative 0.4%. That meeting with congressional leadership and the president taking place in the Oval Office at 4 p.m. Eastern time. After that, the focus is going to shift to CPI in America tomorrow morning, then on to PPI the day after that. Futures softer, lower, negative. Yields down 2 by a couple of basis points. We're down to about 3.4824 on a 10-year. And in the FX market, a break of 110 on a euro against the dollar. Euro dollar 109.75, negative 0.26%.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
The moment news breaks, no one covers the world like Bloomberg.
It would be, of course, a total disaster for Emmanuel Macron because he's been elected on this reform and he would have to basically start from scratch.
It definitely is an exciting day for Apple. First store in India, here in downtown Mumbai, a second one coming up in Delhi.
TK, we've got a lot to talk about.
Debt, China, and the shockingly cautious view the IMF has on the view 5 years forward.
Bloomberg, your global business authority.
from New York City. Welcome to the program this morning. Good morning to you on TV and radio. This is Bloomberg Surveillance, and here's the price action on the S&P 500. If you are just tuning in, welcome. We are negative by 0.4% on the S&P. On the NASDAQ, struggling just a little bit too. We're down by 0.5% on the NASDAQ 100. Futures a bit softer. In the bond market, yields a little bit lower through the curve. 2-year, 10-year, 30-year, down somewhere like 2 to 3 basis points across the curve. On a 2-year, down about 3 to 397. On a 10-year, down 2 basis points to 348. The next stop for this market, of course, the negotiations around the debt ceiling. We all can't wait for that. Then on to tomorrow morning, US CPI, 8:30 Eastern time. Then on to PPI the day after that. Bramo, it's exciting stuff, isn't it?
I'm more excited about CPI and PPI, certainly, than the debt ceiling debate, which I think it's not really hidden how I feel about that discussion. To give you a sense of what's going on in some of the specific names as we do get the rolling earnings come in, I want to talk about 3 different stories. The first, margin compression. The second, artificial intelligence boosting all. The third, job cuts being rewarded in the market. PayPal, margin compression. That is really what you see. They warned that the margins aren't going to grow as quickly as people expected. Those shares down 5.5%. You're seeing a similar kind of trend within the financial services industry more broadly. Palantir just had to say artificial intelligence demand was out of sight, off the charts, incredible. Those shares up 15.4%, given the fact that that is the hot moment, ChatGPT, and your shares go up, sort of like blockchain in another era. And then what you see over at Novavax, the vaccine maker, saying that it was going to cut around a quarter of its workforce, also having some pretty negative prognostications, and those shares up 7%. So how much is this basically rewarding job cuts as being the way to cut to some sort of profitability or increased profitability? It's sort of 3 snapshots of themes that we see throughout the earnings season as people try to adapt and adjust in this new era.
You're sitting in that chair, aren't you?
I'm really
Is that
sitting
why you're
here.
using that phrase?
Oh yeah, I'm going to
adapt and adjust.
I'm going to look at airline tickets and I'm going to adapt and adjust, and we're going to.
You're going to be data dependent.
Always.
We miss TK. TK's going to be back with tomorrow, and until then, Bramo's going to do impressions of TK.
Sleuths.
Subtle ones.
Yeah.
Sleuths. That was a good one.
Thanks,
too.
I appreciate it.
Tomorrow, US CPI. Key data point, of course, for the Federal Reserve. Robert Tipp of PGIM weighing in on that. The markets have already priced in a fairly aggressive easing cycle. He goes on to say, suggesting some upside risk for long rates. Credit spreads are likely to remain range-bound thanks to strong investor demand, allowing the spread sectors to continue registering positive excess returns. Pleased to say that joining us now is Robert Tipp, Chief Investment Strategist, Head of Global Bonds at PGIM Fixed Income. Robert, we talked about the 11th hour. Someone corrected us very quickly and said it won't be the 11th hour, it will be the 11th hour, the 59th minute and the 59th second. And Robert Tipp, maybe that's the case. When we get to the 11th hour, the 59th minute and the 59th second, if it gets messy, Robert, are we buying or selling treasuries?
Right. Well, in the short term, I think you're buying treasuries, right? It'd be a risk-off event, and there may be variations in how the curve deals with it. It could be bad for the back end of the curve. The long end could underperform. But in a flight to quality, treasuries usually do well. We saw that in the SVB crisis, and we've seen it in past debt crises in the U.S. before. And I think that would be the case this time as well. I think it's worth keeping in mind, though, that 12 to 24 months down the road, unless we happen to be right at another debt ceiling debate, I don't think this is going to matter. I think it is extremely important in the short term how it gets resolved, and it may be of epic proportions if you get certain kinds of outcomes, some that are widely envisioned and some maybe less so. But 12 to 24 months from now, I think the basics, the risk here, alluding to your curve, which is expecting rate cuts, is that we may have evolved into a different kind of secular environment where the growth is not so much so debt-driven, and that as a result, growth continues here, and we end up seeing the Fed holding or doing more hikes and getting some upward adjustment in the belly of the yield curve.
Interesting. So, Robert, 2 time horizons there and 2 things to unpack. Let's deal with them separately. Let's deal with the first one, the short term. Do you and the team think this gets solved anytime soon? The debt ceiling gets addressed? And what informs that view? What do you look to, Robert, to get that idea?
Sure. Well, I think the easy part is that it's in nobody's interest to cave early. Everybody wants to show that they negotiated up until the very last minute, And the system, in a way, is in place. The United States, this freak of nature with this messy system that's been, ultimately very successful, is designed to prevent any one idea, any one party, any one group from getting too much power. So it's very hard to move anything forward or stop anything. This is going to go right down to the last minute. I think what'll be interesting, in a way, though, is if Joe Biden goes for a power play of sorts, ends up being kind of a sleeper in the sense of continues to say, this is the best budget that you could pass, and all of the spending, all the taxes, these are the best policies that you could come up with. You need to have the borrowing capacity. And if they do not give him a clean increase in the debt ceiling, that invokes the 14th Amendment, goes ahead and makes the payment. And the worst case scenario would be that then, the government is sued effectively. I'm not a legal expert. And either it's upheld or it's shot down. If it's shot down, well, then every time you come up against the debt ceiling, you have to get it raised. But on the other hand, if it's upheld and prioritization of principal and interest payments is allowed, then this thing is gone forever. In a way, that's a loss, in that it allows profligate increases in debt to GDP to continue ad nauseum. But in terms of traders and anxiety, it would be a big win.
Well, this is something that Jenny Yellen has called a constitutional crisis, should it be invoked. So it's not necessarily what they want to have happen at a time when they do not want the legal challenges and they want some sort of consensus. Let's put that aside for 1 minute, Robert, and get your sense of how this is going to work if the market just sits on its hands. Are you concerned that a lack of reaction as everyone waits for the 11th hour, 59th minute, and 59th second to make any kind of moves will mean that this actually will not get done in time?
I think that you are going to see an increase in anxiety as the balances run low. And, if there's an accidental default, you will see a drop in stock prices, a drop in yields, and a widening of credit spreads. But I think that the economy is pretty resilient to those kinds of shocks. I mean, whether you're looking at October 1987 and the stock market decline then, whether you're looking at the volatility surge in 2018, the economy is not derailed by those incidents of volatility. And most like the current cycle is the increase in interest rates, say in 1994. Quick Fed rate hike cycle, a lot of volatility in the markets, economy powers through that. So again, I think 12 to 24 months from now, this is not going to be a major economic event. It could, though, in the short term, be very jarring for the markets.
Well, how do you play that? I mean, is it frustrating for you? Do you feel like you're being used as a pawn, as a market participant in Washington's games, or is this a good trading opportunity where perhaps you can get ahead and have an edge?
Yeah, I think there's a little bit of each. I think that in the CDS markets, in terms of the term structure there, I mean, people are paying real money to protect against a default in the short term. And, there could be a trade to do there. But I think as an investor, everybody has their edge. And I would think, for investors, their edge may be in assessing what's the 12 to 24 month environment, how are fundamentals dramatically differently priced from where they should be. And I think right now is one of those environments where the market is heavily biased towards pricing in a recession. And having a more optimistic view is going to be the best approach. Tactical trades on the debt ceiling, I think you could do on the margin, but should not be a major aspect.
Did you buy some Apple debt yesterday, Robert?
Yeah, I'm not going to comment on
I didn't expect you to.
Trades. Yeah.
But you can build on it a little bit, Robert, if you can.
I think the market here, is supportive. Here. It sees yields as having traversed the range of the last 10, 20 years, and yields are attractive. And I think some of the inversion of the curve, the demand for corporate bonds, the fact that spreads are supported in the face of what people think is going to be a recession is indicative of the fact that people need yield. And that the market is well supported and that you're likely to see spreads, the range that we've seen over the last year is going to hold.
Robert Tipp at PGIM, diplomatic at the end there. Thank you, sir. Robert Tipp on a credit market, constructive. Looking at Apple yesterday, so as I understand it, just the way this story evolved through the day, Bramo, based on our reporting, is that the order book was huge, tons and tons of demand, and then they tightened things up and demand kind of faded a little bit.
That basically there was a real-time pricing where Apple was like, let's push this and see how far we can go because you guys wanted this so badly, here you go. And then people said, wait a second, when we're looking for income, we're actually looking for income. And at a certain point, we're just going to draw the line. So what you are seeing is that, yes, there is a ton of demand, but they are exacting a price that investors would like the income, and if it's not there, they're not going to buy. And that's an interesting distinction. It's not a free-for-all. It's not a food fight.
It's not the market that it was a couple of years ago.
Exactly. It's not 2013, 2014. This is a different environment where people are prioritizing income.
Or even the post-pandemic years when the Fed just sort of buried rates and was buying bonds every month.
It's the same thing. I mean, it's basically the same story. Basically, when the Fed is supporting the market and when they're putting that bid in and they're putting their thumb on the scale, people don't care as much about income because there is none elsewhere. Now, all of a sudden, that equation has changed, and I wonder whether Apple selling this bond deal, it's not actually that much. $5.25 billion is nothing for them. So is this basically a test to understand what the level is for them to tap and to sort of have access to this market, but not a real financing?
It's kind of like the LVMH deal from a number of weeks ago.
Yeah.
When you get these really great companies with fat margins, great profits, and they don't issue that much debt, and they come to the market, you know, like, when was the last time Apple came? August?
Yeah.
Last year, similar amount. What can you learn from it?
You can learn what the almost risk-free rate is, basically what the corporate rate is for the highest rated and most highly sought after paper is. Basically, what's the line in the sand in terms of income on corporate debt?
We're finding that out slowly. Finding out as well from the SLUs. Just wanted to fit in the SLUs.
I know.
The Senior Loan Officer Opinion Survey that came out yesterday, that things are tightening up and demand is weakening too. But as many people have pointed out this morning, it feels like that's a feature of monetary policy and not a bug. Wait for the next one.
Okay, so is it really a problem if it's just gradual? Is it make a big difference if it's all at once or if it's gradual? And some people are saying yes, and other people are saying just wait for it. It'll, you know, it's all at once. Suddenly, quietly, and then all at once.
Citi still sees hikes in June and July.
I mean, the CPI tomorrow, it's expected to be hot.
8:30 Eastern Time tomorrow morning. Neil Dutta joins us at 8:30 Eastern Time this morning. We'll catch up with him in about 50 minutes' time from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says that if Congress fails to raise a debt ceiling, it would have an adverse impact on the use of the dollar worldwide and would be an economic catastrophe for the nation. She told CNBC that the government would also need to figure out, quote, what to do with the resources that we do have. President Biden is meeting with congressional leaders today about the debt ceiling. The public's not showing much confidence in Federal Reserve Chair Jerome Powell. According to a new Gallup poll, only 36% of U.S. adults say they have a great deal or a fair amount of confidence that Powell would do or recommend the right thing for the economy. That's the lowest level recorded since Gallup began tracking public confidence in the Fed chair in 2001. Senate Republican leader Mitch McConnell predicts that Congress will keep funding Ukraine's defense. That's despite growing calls from some members of his own party to reduce or end the aid. McConnell has called on President Biden to speed up shipments of high-tech weapons to Ukraine. Ryanair is betting big on the travel recovery that's picked up pace in recent months. Bloomberg's learned that Europe's largest discount airline is close to placing an order with Boeing for about 150 737 MAX 10 jets. Now, Ryanair is Boeing's biggest customer in Europe. And Under Armour keeps struggling in its turnaround effort. The athletic gear maker fell after its full-year earnings missed estimates. Under Armour warned in February that a buildup in inventory would lead to more promotions across the category, and recovery would take longer than expected. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000 what would you say that person should do with $100,000 to put in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
DOJ or other authorities
could face bigger challenges next.
It was going to keep rating World Cup. This is a 3.
As the economic picture does. The OK is getting ready to make a decision.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
I think that the market is underpricing the risk of the Fed remaining on hold for the remainder of the year. We're pricing in cuts for the second half of the year. If we can get past the regional banking crisis, I don't see any reason for the Fed to jump into cutting rates in the second half.
Subhadra Rajappa there, the head of US rate strategy at SocGen on the great rate debate right now. The question that Lisa and I have asked all this morning, can this market have its rate cuts and its growth too? And there seems to be some pushback against that, Lisa. I think you gave the one exception, and you're right to point it out. The one thing that can get this done is the so-called immaculate disinflation. If we can get that, there's a reason for the Fed to back away, and obviously that happens without growth getting hammered.
The likelihood of that is pretty much nil, which is what a lot of people keep pointing to the data, which we get tomorrow and then on Thursday, which should show a stickiness to the inflation. But to me, this is the main question, and this tension is not getting resolved month after month, which is, are we going to see massive rate cuts in the face of some massive crisis, or are we going to see rates that are much higher with no rate cuts for a substantial period of time, which is going to torpedo certain equity valuations, and these polls are not getting resolved.
If it's because, quote, a massive crisis, that doesn't sound like a reason to buy stocks, does it?
But that's exactly right. So that's the reason why you're seeing equities rally. It's sort of a confusing conundrum that people have. Everyone's talking it down, and then more people say, look, you guys have been bearish forever, so what makes you think you're going to be right now?
PacWest not rallying this morning. That's one to watch in the pre-market. A move of about 60 cents now works out to about 10% of the overall name. That's trading at about $5 in the pre-market. Lisa, we're down almost 10% in early trading.
And if you look at the KBW index, it just hasn't recovered. I just keep going back to that, even though people are saying it's over. It's, everything is stable. You're seeing deposits stabilize. Now it's a profitability question. At what point do we say it actually is over? And can we move on to really discussing the fundamentals?
KRX, the regional bank index, has just been there bouncing along the bottom for 2 months now.
Exactly.
2 months, can't get a rally.
Is this a profitability question? Is this basically people waiting for the next shoe to drop with another one, especially with commercial real estate? I know I am sitting in this chair, so I'm going to bring up commercial real estate too.
Sure.
Which is something that people are very concerned about.
Too. I haven't noticed that. I have noticed that. He likes to talk about that a lot.
He tracks the buildings in different cities and then sees anecdotal declines in specific ones and then says, the sky's falling. But it is in certain sectors, but in others it's not, which is the reason why it's a bit difficult to get your hands around.
TK's dashboard, like squirrels running around. Commercial real estate. What else is on there?
Airline tickets.
Airline tickets.
First class to Europe, to around the world.
Or wherever. Asia somewhere.
Or Asia. There also is, of course, the TOTS and scores and like the clips.
Buzzwords.
Yeah.
Adjust and adapt and stuff like that.
And then, of course, bow tie, scrolling.
He scrolls through bow ties. Is that what you're suggesting? TK. Bramo. He scrolls through bow ties. Nice.
I don't know. I'll do some more investigating.
Speaking of buzzwords, if you want to get a bid in your stock right now, you hold an earnings call and you just talk about AI. And the problem that I've got with that at the moment is that I've got no idea if it's just a tech bro BSing me or whether there's actually something fundamental to the company here and there's a reason to buy the name.
I think you're not alone. I mean, how about Microsoft? They come out artificial intelligence is going to make us Bing all the way home, and we're going to take over.
Over my head,
and we're going to take over, and we're going to eat Google's lunch. And then other people say, well, actually, Google's in a great position, and they just didn't do a good enough PR job, and that's the reason why their shares didn't pop a lot. I don't think anyone really has a sense of what's going to give someone the upper hand, because a lot of the technology, the neural nets underpinning this, have a lot of question marks around them that even the professionals cannot really answer.
Zombie roll-up. My Bloomberg's lighting up now. People are coming up with TK phrases. Mandeep Singh joined us now, Senior Technology Analyst for Bloomberg Intelligence. Mandeep, can you help me understand what's happening with AI and help guide us all? When there are these earnings calls and these executives talk about the benefits of AI and how well positioned they are, how well positioned are some of these companies, Mandeep?
Well, so I would look at it in two different ways. One is you have to look at the companies that are enabling the infrastructure, the chip companies, and we can talk about valuation, but there is something underlying that is enabling this AI wave, really cloud capacity, the processing capacity you have, and the latest chips we have. And some of it has to do with the other aspect of it is the data side of it. How do you train these models? I think a lot of companies are realizing, they didn't have the IP on the data sets that they're training these models on. So clearly there is value in terms of leveraging, AI in terms of what we have done over the last 5 years with machine learning. And this is the logical next step. But in terms of the applications that will be really disruptive, we don't know that yet. And I think every CEO right now wants to leverage this, but they obviously are trying to figure out, what is the best possible way to monetize this technology.
Palantir Technologies came out and said that demand for its new artificial intelligence tool due this month is, quote, without precedent. In response, the shares surged 21%, even though we don't have exactly a concrete sense of what that exactly was going to mean. Now the share's up about 17% pre-market trading. How do you gauge, Mandeep, whether something is real or simply just a new fad on Wall Street?
Well, so I do want to use my infrastructure versus application lens. I think infrastructure revenue will be more tangible in the near term, simply because that's what will help you build these applications. In terms of what will get disruptive, whether it's search or anything on the software side, only time will tell, because the efficacy of using that software or using those search results is yet to be determined. Although I think the initial response is, yes, this is something better than what we used to have. And if we are able to weed out the noise, then people can see it driving productivity. So I won't call everything is a bubble, but in the case of like Palantir, for example, they are a very specialized software. It's great for, doing fraud detection or maybe detecting cyber attacks, but it's not a solution that you can roll out to thousands or, millions of customers, because it can be customized so quickly. So the fact that they are talking about AI is too soon to me. Yes, they are investing in it, but I don't think they're at a point where they will be able to monetize it anytime soon.
Mandeep, just to get your sense on the whole machines versus humans kind of debate, because a lot of people are wondering what limits there should be on this. And we've heard from a number of tech executives that they are concerned about unfettered use of technology and theory, frankly, that people don't understand if they try to extrapolate it out, what it will mean. What do you think the likely outgrowth of that will be? How many sort of self-imposed restrictions on the development of some of the sort of more nuanced artificial intelligence, the sort of more human-like aspects, and how they will be implemented?
I mean, the best way to frame it is look at, how the internet content is consumed. And there are safety issues around it, and you put guardrails in terms of who can access, that type of content that may be nefarious or, is not something you want your kids to be exposed to. And over time, these things develop. I think regulators will probably be late in terms of, putting those guardrails. But I do think, from a productivity standpoint, you can see how, if you can enhance somebody's learning. And that's where, the bad aspects got highlighted first, that it could write a kid's essay for college. But what about if it enhances learning? And that's what I think Khan Academy has talked about. And there you could see value in something like AI, being that personal assistant for a student. And so I do think, use cases will evolve, and yes, you have to focus on safety, and the regulators will come in eventually. But like with any new technology, you will see the disruptive aspects first, and then you put the guardrails.
Students need personal assistance,
I
Pramo.
knew you were going to
That's what
pick
you
up
were
on that.
thinking
Of course,
wasn't it?
exactly. I was thinking, well, can I have one? But yeah, they're going to get personal assistance to do what? I mean, that's really the question. Are they going to get personal assistance to write their essays, or are they going to get personal assistance to sort of get the information that they need to write said essays? And it will be more of a critical thinking exercise? Does this widen the divide between people who are, I don't know, it raises a lot of questions.
Mandeep, thank you. Mandeep Singh there. When Mandeep talked about it writing an essay, said we highlighted some of the bad things. What's bad about that? All this is going to highlight is how pointless some of these things are that we get taught at school. That's all it highlights.
Okay, hold up. I have to help with some of these situations and these, this is
how do you
arisen.
intend to help? Go on.
Okay, I mean, just at a personal level, as a parent of offspring that have to write essays that have alleged that others are using ChatGPT to write their essays. There is a concern and there is an importance just in the development and critical thinking and organizing thoughts of being able to research information and to be able to concisely put it together in some sort of coherent document. That is what ChatGPT does for people. So they lose the exercise of doing that, which I do think is useful. That said, could you then open up to questions that are more qualitative, that are more difficult and more nuanced to write? And how quickly can they do that before ChatGPT catches up? It raises a lot of questions. I mean, with a personal assistant, what are they assisting in?
We're on the same page on the critical thinking skills, without a doubt.
Yeah, that's important. I want that.
I agree. But there are so many other things that you get taught at school, which are just utterly pointless.
I mean,
I'm happy to outsource that. If I was a kid, I'd just be like, that's productive.
A calculator.
Good on them. Good on them.
So I notice in a couple of drugstores, even in my area, which is not the poorest area in Washington, D.C., it's a nice upscale sort of area. When I want to get razor blades, you have to go to the front of the place and ask somebody to unlock it. Why are you locking up razor blades and other things that I might want to buy?
Yes. So, this is a national problem. And, this isn't, random theft. This is organized crime. And, state legislation has put guidelines on, how much the theft that you can steal before you're convicted. So it's a $1,000 limit. But we have been partnering with other retailers and sharing our camera feed. I know some of our partners here from Walmart are here, but we're all part of an organization that's coming together that says if you've, we can put our camera feed together and tell that that person has been in our store and their store, and the numbers are higher than 1,000. So we've been able to impact these theft rings most recently.
What are the things that are unlocking key the most? What are people trying to steal the most, other than razor blades? I guess?
I will tell you, it started at razor blades because that's such a high ticket item, but, it's a lot of cosmetics. But really what happens is that they take advantage of what I would call the elbow move, and they just come in and swipe a counter. And so it's just a matter of categories now.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. Yeah. There's nothing closer than the phone in your hand.
tightening of credit conditions in the wake of the bank failures is going to be a very big deal.
The bank ecosystem that the United States has is internationally unusual. America has a lot of banks.
There's going to be this enduring tension where pretty decent news means earnings don't collapse.
It's going to be very hard for a meaningful decline in yields from here on as well. So it's going to be one of those situations where yields remain range-bound.
The market has shifted its focus away from inflation and back to growth.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
If you're serious about occupying that chair, you've got to bang the keyboard and clear your throat. All right, repeatedly. But the worst possible time. At the worst possible time.
I'm trying. I don't know. I don't think I can keep this up.
Never hear him clear his throat when we're off air. That's just super smooth. From New York City this morning. Good morning. Good morning. Just needs to be heard. This is Bloomberg Surveillance on TV and radio.
Can't do it.
I should just record it and press play. Equity futures on the S&P 500, negative 0.4%. With Lisa Abramowitz, I'm Jonathan Farrow. TK back with us tomorrow with a full array of sound effects. Going into CPI tomorrow morning, 8:30 Eastern Time. Then on to PPI the day after that. A little bit later on this afternoon, we're all focused on this meeting between the President and congressional leadership in the Oval Office, 4 p.m. Eastern Time. The debt ceiling showdown. But ultimately, you speak to people who are well connected to this story, Lisa, and they will tell you the same thing. They don't think anything happens today.
There's no way that anything happens today because they need to wait for the whole debate to drag on long enough to be able to have political cover to say, we did our best. And so this is a reason why the market isn't responding. And yet we've been talking about it all morning. Politicians are waiting for the market to respond. So this is going to be fun.
Rose-tinted glasses in the market. You get the best of all worlds. Durable growth, rate cuts, robust earnings in a high nominal growth world. It's pretty decent stuff, isn't it?
In fairness to the equity bulls, they've been largely right, especially if they've got in on tech. And so at a certain point, they could say, all right, you doomsdayers, you can keep going with all of your discussions about what's going to happen, but it hasn't been working, so neener. And I mean, at a certain point, there is this frustration that's percolating out where it just isn't necessarily, the logic isn't playing out in markets the way it traditionally does.
The neener. Okay. Lisa Shallett joins us now, Chief Investment Officer at Morgan Stanley Wealth Management. I've got no idea what that was, Bramo. Lisa, thanks for being with us. I won't ask you to translate, Lisa. I will ask you this, though. Just how frustrating is this market, Lisa, when you look at things like all the rate cuts that are being priced, yet at the same time there is this feeling that we will continue to live with durable growth?
Yeah, so look, I think there are a lot of conundrums in this current market, and I think that probably the single most frustrating thing is the benchmark at this point. You know, most institutional investors, most retail investors define the market as the S&P 500 index. That index, as we know, is up almost 8% year to date, up 17% from last October's low. But certainly for the last, 4 or 5 months, a huge portion of that move, at least, since January 31st, has essentially come from 7 stocks, the mega cap tech stocks who led for most of the prior 13 years, what we, I think affectionately nicknamed the FANGs or FANGs M plus whatever. And I think what has been frustrating is that underneath the surface, a lot of the indicators that are flashing recession have crushed the cyclicals. We've seen the devastation of the regional banking system as the Fed has raised rates and as the implications of tightening have begun to show. And yet there's that benchmark, supported by that heavy concentration at the top, chugging along when below the surface, there seems to be, some pain and suffering and damage. Small caps in particular have been crushed.
So, Lisa, the question we've got to ask then is, can this persist? And if it can't, what would bring down some of the big tech heavyweights that have supported this market?
Yes, I think the reality is that in the short term, it can persist. Certainly as long as we're, kind of in this stalemate, I think to your point, between, some labor market resilience, the power of pricing power, and some of the nominal growth drivers that can support some of those names. Now, ultimately, our thesis has been that, there are no companies that ultimately are immune from recession or significant economic slowing. And we don't think that this time ultimately will be different, even though it has felt that way at moments. So our best guess continues to be that there are some earnings disappointments out there. I mean, one of the things that folks have to digest is that the way earnings are modeled, it looks like we're on a hockey stick towards recovery over the next couple of quarters, with this first quarter that's being completed representing a trough in earnings growth, and then we kind of get year-over-year earnings that are better and better every quarter until we get to 2024, where the market's looking for up 13% earnings. Now, we're still very close to peak economic growth and peak corporate profit margins. So that's going to be a feat to achieve those expectations.
Lisa, what would it take for you to throw in the towel and basically just say this time is different?
I think the fundamental issue for us is if we see a reacceleration in economic growth. If the consumer really does prove to be resilient, if the slowing that we expect to emanate really from the credit crunch does not materialize, if there's enough savings cushion, and we would probably see that in the next 2 quarters, where these earnings that look like a hockey stick recovery are achieved. If those earnings are achieved, then quite frankly, our thesis is wrong.
There's another aspect to this that some people keep bringing up, which is perhaps the largest companies are consolidating market share to such a degree and taking it away from smaller companies. So you could see small caps basically blown up, absolutely decline dramatically, which is something that we have seen in certain pockets, even as the large caps continue to chug along and chart really impressive growth. Do you expect that kind of environment, that's going to be the new reality for a while?
I think it is possible. Anything is possible. And certainly there are a host of these companies that have very, very dominant positions. But I do think that we're at a political point, a political moment, where, the tolerance for, further big company consolidation does start to be debated as an antitrust issue in a way that perhaps it hasn't been, quite frankly, for over 40 years since the Reagan administration. And look, some of government inaction is what's gotten us here, and so what may break the logjam may be some attempts at re-regulation.
Have we done the debt ceiling yet, Bramo?
No, go for it.
Would you like to do that now?
No, go for it.
Lisa,
please.
Stick around, please, just for 60 seconds. Lisa, the debt ceiling. When clients ask you about this, what are you and the team telling them at the moment?
The fundamental thing that we're telling them is, look, it's not a question of if, it's a question of when and how. On the question of when, what's critically important from where we sit is what will Janet Yellen do after she gets approval to extend borrowing. And what we mean by that is at what pace and what duration is she going to issue? Because if you're down to kind of a zero in the Treasury General account, it is very possible that in the last 4 months of the year, she's going to be issuing to the tune of $650 to $750 billion, which is a drain of liquidity at the same time that we may have some of these credit crunch issues where we're continuing to pursue quantitative tightening. So the first thing that we're telling clients is beware of the liquidity implications on the other side. The second thing that we're talking about is the how. It matters, to forward-looking expectations of growth in terms of what is cut. If that's what it takes to get a deal done, commitments to cut fiscal spending, what's cut? Are there rollbacks of some of the Inflation Reduction Act spending related opportunities, some of the infrastructure spending? that is kind of in motion, and those things have been a support to growth. And if we need to, take that out of the forward forecasts, that is going to dampen economic growth.
Lisa, wonderful response. Thank you. Lisa Shallett there of Morgan Stanley Wealth Management. In fact, that was fantastic. For people frustrated about talking about the debt ceiling, clip that and just replay it to anyone who asks you about it. The point on growth seems to be so important,
It
Lisa.
is important.
Where is the line on the amount of spending cuts the Democrats would be willing to accept to basically get the Republicans over the line to come to a deal? And will that lead ultimately to slower growth? And the other thing that Lisa mentioned there, all the different cross currents, the conflict there, the debt ceiling, what happens with QT, what's going to happen with growth, the credit crunch potentially of the regional banking issues, none of this is helpful to the cause around growth.
No. And I think the fiscal aspect actually is really important, because even if they don't want to cut the budget that much, it definitely puts a cap. The fact that there is this debate, this ongoing debate, puts a cap on how quickly spending can be accelerated. The fact that it's such a huge election point, you have to imagine it's going to restrain fiscal spending going forward. That is really negative for growth. So if that's the case, do you really get this sort of perfect surge in growth, the way that Lisa was saying would have to happen in order for prices to really be accurate? And yet they haven't come down.
4 p.m. meeting with congressional leaders and the President of the United States in the Oval Office a little bit later on this afternoon. Up next on this program, Terry Haynes of Pangea Policy on today's meeting on the debt ceiling. Looking forward to that conversation in just a moment. Terry's always great. From down in Washington, D.C. Up here in New York City, equity futures negative about 0.3% on the S&P 500, trying to bounce in the FX market. 109 on the euro against the dollar, 109.60, negative 0.4%. Import data out of China, not impressive. Softer growth potentially out of the world's second largest economy relative to the boom hopes of only a few months ago. Yields lower by 2 basis points. Your 10-year, 348.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Senate Republican leader Mitch McConnell warns he has no secret plan to solve the debt limit deadlock. Congressional leaders meet today with President Biden. McConnell says he told the president it was up to him and House Speaker Kevin McCarthy to find a solution. At the same time, McConnell predicts the two sides will reach a deal and avoid a default. Vladimir Putin vowed to pursue his invasion of Ukraine, accusing the Kremlin's enemies of seeking to dismember Russia. Putin spoke at the start of the annual military parade celebrating the Soviet victory in World War II. He said that a real war has been unleashed against the motherland. In Pakistan, former Prime Minister Imran Khan has been detained. The former cricket star faces a number of court cases and was set to be formally indicted Wednesday. Now, that has to do with allegations that he did not properly disclose earnings from the sale of his state gifts from his time in office. Khan has called for early elections next year after getting ousted in April 2022 in a no-confidence vote. Aramco will introduce an additional dividend, potentially boosting payouts for Saudi Arabia's government by billions of dollars. Now, it comes at a time when weaker oil prices are pushing the kingdom's budget into a deficit. Aramco says the new dividend will be between 50 to 70% of the company's annual free cash flow. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg. Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
There needs to be market pressure. Without that market signal, it makes it hard for McCarthy to go to the holdouts who are holding him hostage and say it is time to do a temporary lift of the debt ceiling to get us through and get us a little bit of space to negotiate between, so that nobody loses face at the end of this.
As Lisa has said all morning, we're playing chicken with the S&P 500 down in Washington, D.C. That was Heidi Kribo-Rediker, the senior fellow at the Council on Foreign Relations. Here in New York City, your equity market is not blinking yet. We're negative by 0.3% on the S&P 500. Your bond market isn't either. Yields are lower by just a couple of basis points, down 2 basis points to 348, down about a single basis point on a 2-year, just short of 4%. Let's call it 399 on a 2-year yield. In the FX market, the euro against the dollar, euro-dollar, a break of 110, 109.64. We're negative 0.3%. The next stop, of course, on the data front, CPI coming up tomorrow morning, about 24 hours from now. Then on to PPI after that, and plenty of Fed speak, no doubt, in between. But at 4 p.m. Eastern time, it's a major conversation we've all been waiting for between the President of the United States and congressional leadership, including House Speaker Kevin McCarthy. Terry Haynes of Pangea Policy, the founder, joins us now. Terry, you said this: we can expect some soothing, no default platitudes after the meeting later. Terry, anything else other than that?
No, I don't think so, John. I mean, I do think you're going to get a little bit of platitude. Without saying that they will absolutely not default. They'll say they don't want to. None of them want to. But they'll also kind of harden their positions, I think. Biden's position has always been that you can't cut spending at all, really. That's usually the Democratic going in position. You can't cut spending on domestic discretionary. And Republicans are going to talk about the need to cut back, in their view, modestly to fiscal 22 levels. So this gap is bridgeable, but nobody's really interested in bridging it yet.
What's the sort of over/under and how much they want soothing platitudes versus histrionic proclamations that the sky is falling to get the markets interested?
Well, if you can do both, that's optimal, I think. Yeah, they're trying real hard to get the markets interested, and so far the markets aren't cooperating. And to the extent the markets are cooperating, what they're seeing, I think, is the Republicans having done something, however imperfect, and whereas Biden hasn't done anything, which is why Biden now is bringing everybody to the White House to show that he too is actually interested in doing some sort of a deal, albeit without climbing completely down from the perch that he's not negotiating.
You said that there is a 30% likelihood of a default. That is the probability that you come up. How do you come up with these probabilities?
Well, how I view this, and in fairness, I've viewed this as being a 30 to 40% likelihood, the moment we're in right now, since last November. But fundamentally, is there a 1 in 3 chance that somebody makes a serious mistake here? Yeah, I think so. I think that's not, I think that's more than a trailing risk. And what is happening today, I think, will illustrate that, because to the extent anybody's looking at this moment and suggesting that there's going to be the beginning of a constructive path here, I think isn't reading the signals properly.
Terry, what is the one thing, the one signal, the one thing you can identify that would make you think that it could be different this time?
Well, if I'm wrong on the suggestion that they stick to their spending, the kind of their spending guns, and say, we're going to sit down over a period of time and work this out, and give markets some reassurance that not only will the problem be solved, but it will be solved, on a particular date. That I'm wrong. But that's not at all what I'm seeing or hearing.
On the X date, we've heard as early as possibly early June. Terry, what's your read on that? How conservative do you think the Treasury Secretary needs to be about the so-called X date? How much more padding? Weeks, months? What would she do?
Well, I think she needs to be as transparent as possible, first of all. Second of all, I think she needs to avoid the mistakes that some prior Treasury secretaries have made, of both parties, frankly, where they surprise policymakers, whether it be surprise your own president or surprise Congress. There's going to be enough volatility in the negotiations here without adding to it the volatility of a Treasury secretary kind of hiding the ball till the last minute. I mean, she needs to be putting as many cards on the table as possible, frankly, because then not only will that help negotiations, that'll help markets.
Terry, this is kind of related, but earlier this morning, John was talking about how Jay Powell faces the lowest confidence and the lowest backing from the public in history. This according to a Gallup poll. And this poll also had the lowest confidence. If you take a look at all the politicians, whether it's Republican or Democratic Party, pretty much across the board, as they looked at what's going on with the debt ceiling debate, is what they look at what they see as just sort of general dysfunction. How much has this become something that has been entrenched and basically just an accepted fact that there is a lack of confidence in public officials in Washington, D.C.?
I think it's quite entrenched. It's, for a long time, frankly. What I found interesting about the Gallup poll, by the way, is that if you combine all these numbers are pretty tight, by the way, but if you combine the kind of high to low confidence numbers, House Republican leaders come out the best, but not by much. Then Yellen, then Powell, and the Democrats, Yellen, Powell, but Biden comes out the least. And that's not a good sign either. But what it ought to tell the White House is that there's an opportunity here to, frankly, enhance the president's own standing if he takes leadership on a deal.
Interesting. Terry, wonderful perspective. I enjoy catching up with you always. Terry Haynes there of Pangea Policy. Lisa mentioning some of the polls. More broadly, you're right, Lisa. It's not just the Fed chair, Jay Powell. It's pretty much everyone down in Washington, D.C. And there is a number for Treasury Secretary Janet Yellen, 37%. So that's the lowest for any Treasury Secretary going back to Jack Lew. Jack Lew was at 20% in 2014. I mean, that sounds absolutely savage, doesn't it? 20%.
Yes, it wasn't exactly encouraging. Was he the one with a lot of circles?
The squiggle.
Yeah.
The squiggle.
Thanks.
The terrible signature.
I mean,
yeah,
I
never understood it.
I actually think it's better than mine, but I mean, it's very
If you're going to sign bills, I mean, come on.
What? It just was a lot of zeros next to each other. But maybe that was his practiced one. Maybe he wanted it to be the squiggle. I don't know. Anyway, that maybe was why he had undermined confidence. I do think it's an important issue, though, especially at a time when people are sort of rolling their eyes at this and saying, really, another debt ceiling debate? And I think that really speaks to the lack of confidence that people have in Washington, D.C.
Hardly a ringing endorsement of Congress. 38% of Americans have confidence in congressional Republicans on the economy compared to 34% for congressional Democrats.
I mean,
that's like lose-lose across the board.
Pretty much, that's exactly what we're looking for. And it's sort of a competition for who can lose least. It's not exactly a ringing endorsement of
Sums
the
up Washington, D.C., doesn't it?
I mean, I
might sum up this meeting a little bit later on this afternoon.
Well, yeah, that's sort of what we're going to see is a lot of posturing after the fact. And,
there's no winners here. There's winners here, that's for sure, around this table, Bramo. You're a winner. Coming up at the Open on Bloomberg TV. This is what it looks like. Seema Shah of Principal Asset Management, Chris Mamani of Lafayette College, Aaron Cannon of Clear Harbor Asset Management, and, drumroll, we'll catch up with Henrietta Trays of Vader Partners. Looking forward to catching up with Henrietta around this debt ceiling nonsense, Lisa, going into this meeting a little bit later this afternoon.
Very cool. It'll be very cool to hear what she has to say. I also do wonder, with the politics of the moment, the fact that we are seeing this shift with big companies doing a lot better than smaller companies, and whether anyone addresses that. I was just looking at a story that big bank bonuses jumped 20% at regionals. people are getting paid that much less. And I'm watching this and I'm just thinking to myself, how are they going to keep employees? But this is just something that's going on more broadly. Smaller companies are losing out to bigger companies in a massive way. And this is going to become a massive political issue as well.
It's a stock market issue.
Yeah,
Lisa Shallow said it about 20 minutes ago. Small caps, terrible, weighted towards the financials. Big caps, large caps, mega caps, S&P 500, weighted towards tech is holding up nicely.
But this, to me, raises a question. If you're an employee, you're going to get paid more to a big company. They're going to be able to withstand pricing pressure, et cetera, et cetera. I don't know. It's an interesting moment for an economy that relies on the small businesses, and they have more political voice as well.
And you can contribute to that wonderful culture that exists at large companies, you know?
You're in a rare mood today. It's been lovely.
Have you not heard about that?
No, what?
All the big banks
The
that want you to
culture?
come to work to contribute to the culture.
You love the
on
culture,
Wall Street.
don't you?
I think it's so important.
You're gonna wear a flag,
It's
hat,
so important
scarf?
to contribute to the culture and be part of the family. so important.
Until you're kicked out.
From New York.
Disgracing the family.
This is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Welcome Welcome back. This is Bloomberg Surveillance. Tom Keene, Jonathan Farrow, Lisa Abramowitz. Tom off. He will be back tomorrow. John, onto his next thing. And here with me is Neil Dutta. We'll get to him in 1 second. In the markets, you are seeing a softer tone after, I guess, yesterday's SLOOS data, the Senior Loan Officer Opinion Survey. However, to give narrative to this is really difficult on any given day. Interesting that we also got that optimism, small business optimism survey that came out earlier this morning that was disappointing. We are seeing a bit of a bid into treasuries, yields lower, 3.49% on a 10-year. A bit of dollar strength, euro weakness, 109.62. Crude softer, and this has been really a trend. We have just seen that incredible weakness as people gauge out what recession means, even if they're perhaps not seeing it in some of the fundamental data. Tomorrow, we do get CPI data where we're going to be taking a look at inflation. Do we have to start being worried about inflation again and the prospect for the Fed hiking rates further, or are we going to see some sort of softening? And then on to PPI, a real question underpinning a market, especially as we get small businesses showing signs of stress and big businesses reporting better than expected earnings and a consumer very much willing to spend. Putting these two things together, one of my favorite economists ever, Neil Dutta, joining us now. I always love hashing this through with you. He's head of U.S. economic research at Renaissance Macro. I want to start there. What's going to win here? The consumers who keep spending and now are borrowing, or companies that are pulling back spending and being more conservative?
No, I think the consumers will win. Historically, the causality goes from consumers to businesses, right? So I think the issue is that, companies have been preparing now for several quarters for a recession that hasn't yet arrived. And I think they're moving further away, they're further offsides on growth. And, if the consumer continues to hang in there may be a period of catch-up that happens where they have to restock, adjust their CapEx budgets, maybe hire a bit more, post more openings. So I definitely, to me, it's also, Lisa, as you know, it's really about what is the consensus pricing in, and then what is the likely outcome, going to be, and then you try to pick your battles as wisely as you can. And, to me, the consensus right now is expecting a recession to start really in this quarter. June, Q3. The Bloomberg News consensus, I think, is for flat growth in each of the next 2 quarters. And I don't know. It just doesn't seem like that's going to happen. We had a strong auto sales number for April. It looks like core retail sales will come in stronger for April. We know from the public builders that April was a very strong month for new home sales. So,
okay. Taking a step back, let's tease this out a little bit.
Okay.
You said when you're talking about how the consensus, is the consensus of a survey of economists, or is the consensus what's priced into stock valuation?
Well, look, the bond market's also out there pricing in rate cuts. And I think, 200 basis points worth of cuts between now and the end of next year? That's hard to see in the context of a strong economy, right? So, or even an economy that's treading water. People clearly expect some weakness in the economy. I think, with respect to equities, equities are still well off the highs, obviously. We've seen some rally of late. But yeah, I think you can make a case to say that the outlook for stocks is somewhat ambiguous, right? If recession risk gets priced out, that should be good for earnings, but at the same time, that probably leaves the prospect of the Fed, future rate hikes still on the table, which could weigh on stocks.
What would we have to see tomorrow for the CPI report to shock this market, to say, wait a second, we have to start thinking about the Fed staying at 5%, possibly going up to 5.50, more than rate cuts, which are being significantly priced in?
Well, I do think that there's scope for some upside surprises on inflation. The question is whether the Fed is going to lean into that by continuing to hike over the summer. I don't think they will. I think that they probably take a pause. We have, essentially, they're captured to some extent by events, right? The regional banking issues, obviously, there's still an issue there. We also have the debt limit negotiations. So there's things out there that they can point to kind of keep them away from hiking over the summer. But ultimately, I think if the inflation numbers stay relatively firm, if the economy is still holding up, we're clearly not growing below trend, right? The unemployment rate is not going to rise as much as the Fed expects, right? We're at 3.4%. The Fed's looking for a percentage point increase between now and the end of the year. I don't really see anything in the outlook that justifies that kind of a move. So you could be coming back in September talking about maybe they're revising down their unemployment forecast. Maybe they're taking up GDP, and that could, push them towards hiking again.
It's difficult to know what's going to happen in the future. It's incredibly difficult to even know what's happening right now because the signals are muddied. And perhaps you disagree. I'd love the argument, but I do see that, for example, the senior loan officer survey, to me, even though perhaps nothing was that surprising with credit tightening, we did see a huge drop-off in demand. Again, the C-suite confidence factor, not there, or else not willing to pay for the credit. And when you look at optimism among business executives, and anecdotally, they say we are very concerned about what's coming down the pike, about inflation, about how much we have to pay our workers, about our squeezed margins. So how do you pair these ideas with the strength that we're seeing in the overall kind of numbers that we're getting out of these sort of regular surveys?
I mean, CEO confidence and business confidence more generally has been quite sluggish pretty much since last June. And companies have been slowly cutting back CapEx. Inventories have been a significant drag on growth over the last year. So, and consumers have been, their confidence has been pretty weak also. But ultimately, to me, it's what are they actually doing? Companies are still hiring people, right? I mean, these depressed businesses, they're still going out and hiring 200,000 people a month, every month, for the last 3 months. The hiring rate is basically stable at around 4%. You haven't really seen, right? So there's a disconnect between how people say they may feel about things, but what they're actually going out and doing. And I'm more concerned about what people are actually doing.
Although you did see that businesses are not engaging in mergers and acquisitions. They're not doing capital expenditures, which directly goes into economic trajectory. They're not pulling the trigger on things, right? Which has been one of the things, the reasons.
Well, some things will get clipped, Lisa, in a higher interest rate environment, like M&A. But, you talk about CapEx. Boeing orders are going up, right? Boeing production's going to go up. That's going to be a huge tailwind for transportation equipment, right? Those are capital goods. Those are big ticket purchases. So, but again, it's not that the economy has to be booming here, right? So there's this sort of, there's this expectation that, GDP needs to be like 3%. No, it doesn't. The issue is, where's the consensus thinking it's going to be, right? And to me, look, the Fed's forecast is 0.4% Q4 this year. That's highly unlikely, just given what we have on hand for the second quarter.
We're talking about the short term, or the relatively near term, in terms of growth continuing. Longer term, there is this question of whether we're bringing forward growth, especially in light of what everyone loves to talk about, the debt ceiling debate, which we've been talking about all morning, and this question of whether they're going to be cutting spending going forward. How do you sort of pair the short term versus the long term, the short term optimism in ongoing strength in the economy versus long term, perhaps sluggishness?
Yeah, I think so, right. That's, I think my primary, disagreement with the consensus is really over the timing, right? I don't see a recession as imminent. I don't see one as likely at any point in the next, let's say 12 months. But the Fed has told us that they believe a period of below-trend growth is required to quell the inflation issue. So that's where the caution comes from. So I think if you want to be honest with yourself, ultimately, there's going to be some kind of economic slump that's out there that the Fed will try to engineer to bring inflation back towards its target. If you really believe in the soft landing at this point, you need to be hanging your hat on two things. Number one, some kind of a productivity boom that brings unit labor costs down, or the Fed basically accepts a higher rate of inflation. And I don't see either as a baseline expectation going forward. So again, it's about the momentum in the economy right now. To me, that doesn't speak to a recession. But as I said, the Fed still believes that below-trend growth is required to quell the inflation issue. So to me, that leaves, you have to kind of stay cautious. I know it's sort of it's a difficult environment, I think, for investors, because it's hard to be sort of sustainably optimistic on equities here, right? So I think that's part of the frustration.
Just before you go, I would love your thoughts on the debt ceiling and what we're seeing and the excitement that you expect in markets as a response.
I mean, that's sort of a bit, I mean, I think we're going through a very public and open negotiation from both sides politically. Whether the deadline's actually June 1st or not, I think the House Republicans have done what they needed to do. I think the administration is doing what they need to do, and I think ultimately there will be some sort of negotiation that resolves the issue. I mean, to me, it's a binary thing, right? I mean, you either go over the cliff or not. I suspect they won't. And if they do get to a point where they're prioritizing payments, I mean, that'll be an opportunity to be buying bonds because, I mean, basically, you're basically forcing a recession on the economy over the summer at that point.
So you don't think longer term, and this is where I wanted to go, that this will reduce the U.S.'s ability to borrow cheaply and the ability for the dollar to be used globally in sort of the
What's the alternative? What's the alternative? No, I don't. I mean, this is just. I mean, to me, it's political rankering. We'll see what happens, but I don't really subscribe to those ideas.
So, is this basically the most fun time you've ever had as an economist?
No, the most fun time actually was when the job was a lot easier in the period immediately following the financial crisis, right? I mean, because back then it was. Everyone was looking for a recession literally every, it's around the corner 2 years away, and it was never really in the cards for that entire cycle. And pushing back on that was actually quite easy, and the data easily bore that out. Now it's actually quite challenging because there are so many mixed signals, and I prefer a much easier job than not. So
I think a lot of people would agree with you. Neil Zada, thank you so much of Renaissance Macro Research. We really appreciate it, really highlighting some of the uncertainties as we parse through the push and pull of different aspects of the economy, suffering through very different cycles or experiencing the upturn of consumer spending. They continue to fly. They fly a lot, which is what we're going to be talking about next. Helene Becker of Cowen will be joining to talk about the airline industry and how much people are continuing to go there in markets who are seeing softness here as we head into the trading session, led in part by some of those regional banks, some of those areas that have been beaten up as people try to tease out the next potential catalyst.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Treasury Secretary Janet Yellen says that if Congress fails to raise a debt ceiling, it would have an adverse impact on the use of the dollar worldwide and would be an economic catastrophe for the nation. She told CNBC that the government would also need to figure out, quote, what to do with the resources that we do have. President Biden is meeting with congressional leaders today about the debt ceiling. The public's not showing much confidence in Federal Reserve Chair Jerome Powell. According to a new Gallup poll, 36% of U.S. adults say they have a great deal or a fair amount of confidence that Powell would do or recommend the right thing for the economy. That's the lowest level recorded since Gallup began tracking public confidence in the Fed chair in 2001. Senate Republican leader Mitch McConnell predicts that Congress will keep funding Ukraine's defense. That's despite growing calls from some members of his own party to reduce or end the aid. McConnell has called on President Biden to speed up shipments of high-tech weapons to Ukraine. A big acquisition in the mattress business. Tempur Sealy has agreed to buy a controlling stake in Mattress Firm in a cash and stock deal valued at about $4 billion. Mattress Firm has more than 2,400 stores across 49 states in the U.S. It's owned by South Africa-based Steinhoff International Holdings. And Under Armour keeps struggling in its turnaround effort. The athletic gear maker fell after its full-year earnings missed estimates. Under Armour warned in February that a buildup in inventory would lead to more promotions across the category, and recovery would take longer than expected. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this
Is
story.
there the kind of upside?
You are going to see an increase in anxiety as the balances run low. And, if there's an accidental default, you will see a drop in stock prices, a drop in yields, and a widening of credit spreads. I think 12 to 24 months from now, this is not going to be a major economic event. It could, though, in the short term, be very jarring for the markets.
In the game of chicken, we have the markets basically saying you're not going to default, and Washington is saying, please get more concerned. Robert Tipp there weighing in, chief investment strategist and head of global bonds at PGIM Fixed Income, talking about how the initial response will be to buy bonds. This amid a backdrop of otherwise more resilience than people had expected, particularly when it comes to consumer discretionary spending. And no area defines that more than airlines and travel. And after the bell, we get Airbnb and Wynn Resorts and some of these other consumer discretionary travel-related shares, which have popped immensely so far this year. There is a big question underpinning, particularly air travel, which is how long can prices keep surging well beyond where regular inflation is? And just to give you a sense, in February, year-over-year inflation came in at 27.4% for air flights, just year-over-year. That is incredible. That is more than twice the rate of inflation anywhere. Helene Becker joins us now to talk about how long it's going to continue, whether margins just keep expanding, and when we start to get some of the pushback that we heard from the likes of President Biden himself yesterday. Helene Becker, senior research analyst at Cowen. So let's just start there. Why has it been that consumers are not pushing back more to these incredible price increases?
Well, I think there are two reasons, Lisa. The first is that a year ago in the first quarter, there was still Omicron. So that was one issue. And then the second issue has a lot to do with summer travel, especially international travel. Because remember, a year ago, the U.S. didn't remove restrictions until June 11th. And a lot of people had already, most summer trips are planned between mid-May and mid-March, actually the other way around, right? March and May. And they had already decided where they were going. And a lot of stuff wasn't open yet. So now everything is open. People are tired of being home. They want to travel. They feel like they've missed out on a lot, and they're going. And you have huge demand. We're about equal to where we were in 2019, but we have between 10 and 20% fewer seats available. And the result is that with demand, even with business travel and international not being 100% back, with demand being so strong and exceeding supply, airlines are pushing up fares and will continue to do so until there's significant pushback.
And you're not seeing any significant pushback so far?
I'm not seeing it in the summer months for sure. I'm a little worried about once we get past Labor Day in general, because we normally see a dip, but also I'm a little worried because I think by then people may be exhausted by the prices. And of course, we don't think this summer is going to be significantly better than last summer, especially in the New York area where we have a decided lack of air traffic controllers. And the government asked the airlines if they would help by reducing capacity in the market. And most of the airlines who are operating now have employment that exceeds their pre-pandemic levels. So the airlines were ready. The government is not.
How much are we looking at a real divergence between the international airlines versus the more domestic airlines? And I ask, with also a focus on first class, which is commanding the biggest premium in years relative to economy, how much is really the gains that we have seen entirely driven by that international flight path, the traveler that has that much more discretionary spending?
So Lisa, we're seeing international outbound very strong from the U.S., I think because the dollar has been relatively strong. Inbound, we're still down versus where we were, but outbound, we're above. So I think that's one thing. I think the other part of your question with respect to how the divergence between the two, I think that's definitely a summer 2023 event, maybe into 24 when you get to Asia Pacific, which is reopening now. And then domestic, I don't know, maybe people will be so overwhelmed by the price of some tickets that they'll pivot and either shift days that they travel or shift location. Instead of going to Europe because fares are so high, maybe go to Latin America, Northern South America, domestic. I think you'll see some of that pivoting because of the differential in fares.
Do you think that there's going to be some sort of decline in business travel, or is it coming back nearly to the level that it was pre-pandemic, or even more because people are just working from home and then traveling?
Right. So I don't know the specific answer to that question because my thought has been that business travel will come back in differing measures. So you need to see your clients. After a while, Zoom calls don't cut it, number one. Number two, when you get to time zone differences, it's one thing to be U.S. East Coast to London or Western Europe where you're dealing with a 5 or 6 hour time change. You can kind of make that work. But when you start to get into the 9-hour time changes that exist in the Middle East, or 15 hours or 12 hours that exist to Asia, Australia, Japan, I think people realize it's hard to do Zoom calls at 1 o'clock in the morning for somebody while they're doing these calls. So I think at some point it does start to come back. We've thought that it would be international business would come back faster than domestic. But I think the days of if it's Tuesday, it must be Rome kind of thing are past us. And to the extent you might have a meeting that would be 3 hours long, you can probably get away with a 1 hour or 2 1-hour Zoom calls, not necessarily back to back. But I remember days when I flew to London for due diligence and flew home the same day, land in the morning, fly home at night. I mean, that kind of stuff isn't happening anymore.
How much are we seeing actually the resurgence of the Chinese economy percolate into air travel?
Yeah, not yet. So what you're seeing is what we experienced in the U.S. You see domestic first. So Golden Week, as I understand it, was fairly strong. We should get the numbers tonight or tomorrow. But last week was a very strong week for them. Domestic. International hasn't come back yet because the flights haven't come back. In 2016, there were over 100 flights a week between the U.S. and China, and more between China and Europe. And now there are 14 between the U.S. and China. So flights haven't come back yet. And until that happens, which was probably a 24 event at the earliest, given the political situation, maybe even later, I don't think you're going to see that dynamic come back from a tourist perspective. I think who haven't seen family in a couple of years because of the Chinese COVID policy, which had the country virtually shut down. Yeah. I think you see students making their way back home who maybe were trapped outside of China. But I think it's domestic is where you're seeing the strength versus international.
Just real quick here, we see oil prices coming down, which means that a lot of the margins probably will only expand. At what point do the widening margins become a political liability for some of the airline companies that are facing a lot of criticisms about the experience?
Yeah, I think that's a great question, Lisa. So I think a couple of things. Fuel prices come down. Typically, ticket prices follow with something like a 3 to 4 month lag in both directions. So I think that's one thing to think about. Oil prices come down. If oil prices are coming down because we're in a recession, that should bring ticket prices down as well, maybe take some of the pressure off the airlines. The airlines do a really good job this summer, probably remove some political pressure. The airlines are one of those industries everybody loves to hate. And even though it brings people together, even though to have a good economy, you need a robust airline industry, it's one of those industries everybody likes to pick on. And so they really need to do a better job than they're doing. And I think I guess we're kind of hoping, although that's not a strategy. I think we're thinking that as they invest in technology, things will start to improve for them. But certainly the lack of seats is a problem in terms of recovery from irregular operations. So kind of a lot to unpack there, Lisa. You asked a great question.
Well, thanks. Helene Becker of Cowen, thank you. And I ask this, of course, as President Biden had a meeting yesterday talking about the demand to pay for hotel rooms and compensate people for delays and cancellations. Helene Becker, thank you so much. Coming up on Bloomberg Markets, Stephanie Bunaj, chairman of Euronext, as we parse through the next potential catalyst in a market that has been really stuck in a range, assessing all of the potential ramifications of the emergence from a pandemic and an inflationary shock unlike what we have seen in 40 years. We're seeing bond yields basically unchanged on the 2-year, talking about sort of the stasis that we're seeing, and we're seeing S&P futures down about 0.4%. This is Bloomberg Surveillance. Tom Keene will be back tomorrow. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders. Golf's popularity is surging. That's been great for the LPGA. And CFO Kathy Milthorpe is focused on maintaining that drive.
The ability to be able to compete at the highest level and earn purses that are commensurate with their male counterparts is a mission that we're driving towards every day.
Watch Chief Future Officer, Wednesday on Bloomberg. From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
So what is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. And the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Live from New York City this morning. Good morning, good morning. Your equity market negative, down about 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, Biden meets McCarthy approaching a debt ceiling deadline. Banks report tighter lending standards and weaker demand as public confidence in Fed Chair Jay Powell sinks to a record low. We begin with the big issue. Square this circle.
You've got an incredibly resilient, durable economy.
The U.S. economy has proven a lot more resilient than people thought.
Meanwhile, estimates for the year have actually gone up.
And markets are pricing in 3 cuts for this year.
There is some positioning for rate cuts.
A couple of cuts by year end. I think that's reasonable.
The Fed, which does no interest rate cuts this year, and the market, which I think is going to be right, and we're going to see interest rate cuts this year.
I don't have a huge grumble with market pricing at the moment.
I just don't think the markets have it right.
The equity market is way ahead of itself.
To have the Fed cutting interest rates, to have inflation be well under control, and then to also have earnings basically come in at 220 and the economy continue to grow.
The equity market wants to have its cake and eat it too.
We can't have our cake and eat it too.
I mean, it's the most wishful thinking that we've ever heard of.
Joining us now to discuss, Principal Seema Shah, alongside Krishna Mamani of Lafayette College. I've been asking this question now all morning, Seema. Can we have our rate cuts and our growth too?
Absolutely not. I think the market is being very optimistic here. To get rate cuts, you have one of two scenarios, or even in fact both. You could have a deep recession, which sees the unemployment rate rise very sharply. Today it's at 3.4%, so it seems quite unlikely in the near future. Or the second scenario is you have a financial crisis. Now that seems not a 0% probability, but we would hope that the acute phase is behind us. So taking that into account, it seems very unlikely that you're going to get rate cuts this year.
2 quotes, 2 strategists. Mike Wilson starting the week over at Morgan Stanley saying this: the equity market continues to expect the best of both worlds, rate cuts and durable growth. We view the likelihood of both of those outcomes playing out in concert this year as low. Marko Kolanovic at JP Morgan, same page. If rate cuts happen this year, it will either be because of the onset of a recession or a significant crisis in financial markets. The gap between the bond market, equity market, and the Fed is likely to close at the expense of equities. Krishna Mamani, does that gap close at the expense of stocks?
Well, so I think people are imputing way too much with respect to rate cuts, at least in the equity market. That is, everyone is assuming that bond markets knows what they're doing, which is of course not the case, and I think there's not going to be any rate cuts anytime soon, at least not in third quarter by any measure. But kind of imputing, because of the tech rally, that the entire equity market is really discounting massive rate cuts. I'm not so sure that is a good assertion. The bottom line is, in any tightening cycle, there's only one theme that lasts throughout the whole thing, and we make up stories around it. And in this go around, it's simple. Nominal growth is quite strong. It's coming down. It hasn't come down enough. And inflation was quite high. It is coming down. It hasn't come down enough. That's the regime that is going to be in place. And that's really not a bad regime for equity markets.
So, Krishna, I hear from you again, once more, that you believe the pain trade for equities is higher. Is that still the case?
I think so. I think we are in a trading range. That is, it's kind of hard to see how, even if you get to 4,500, how you sustain it. But I think the pain trade is on the upside, definitely not on the downside. I feel confident about that.
Seema, how do you counter that argument that we live in a high nominal growth world after we've been talking about negative earnings for months and quarters now, and we have to keep pushing out this story? What's the pushback against this?
Yeah, I'm definitely going to have to take the other side on this. So look, yes, if you look around today, things look pretty good. Consumers are clearly spending. The labour market is incredibly strong. But you just have to look at the Senior Loan Officer survey, which came out yesterday, showing that there is a tightening of lending conditions. It's not falling off a cliff by any means. But that tightening in lending conditions will lead to job losses. There's a very, very close relationship between the two. So we are expecting things to get worse. It's not going to be an imminent recession by any means. It's not just 3 months away. We're looking a little bit further out. So it does mean that you could see the equity market stay fairly range bound in the next couple of months if there's no other upsets. But if you're looking at over 6 to 9 month period, it certainly does look like there's going to be earnings growth really under pressure, which is inevitably going to weigh on equity markets in turn.
We've been range bound for months now, all year, 3,800 to 4,200. That has been the well-defined tight range of the year so far. Seema, you heard what Krishna had to say there, that ultimately he believes that the pain traders' equities still go higher. Are you still married to the view that we retest the lows of late last year?
Yeah, we are. As I said, things look good right now. But if you look at any leading indicator, it's giving a fairly clear signal that there is recession down the line. So whereas last year we were talking about rates, we talked a lot about inflation, this year is really about the growth story. And that growth story will deteriorate, but we're looking at it in the second half of this year. So for now, and we could be talking about this for the next 2 or 3 months, the equities market still stay fairly range bound. But you get into late 2023, and I think the situation will be fairly different. That's when actually the equity market can realistically start talking about rate cuts. But until then, I think the story is a little bit more of a range-bound one.
Let's talk about the data right now. Mike McKee joins us to talk about the SLOOS and the Small Business Sentiment Survey, Mike, that came out a little bit earlier this morning.
Yeah, the small business survey is interesting, John, because it showed the biggest decline, or the lowest level, put it that way, in about a decade. The number comes in at 89, which is the 16th consecutive month below the half-century average of 98. But you can see these numbers here show the conundrum that the economy, as a broader sense, has. The pessimism is obvious for small business owners, but look at this. More people plan to increase employment, more have job openings, more think it's a good time to expand. Fewer are raising selling prices, and fewer plan to raise prices. You look at credit needs here, and you talked about the SLOOS. Only 2% say their credit needs are not being met. 30% say they're fine. 59% say, well, we don't have to borrow right now. So at this point, it's kind of hard to say that the economy is giving us any straight signals. So you wonder what the Fed is going to make of something like that. Tomorrow we get the CPI. That's really going to influence a lot of people. But we're not expecting a whole lot of changes there, although, again, the small business owners think that their prices are going down.
Mike McKee, thank you, sir. Looking out for CPI tomorrow morning, 8:30 Eastern Time. Day after that, PPI. Let's talk about this small business survey. Mike McKee talked about the availability of credit. The survey suggested there was not a material change in credit conditions for small businesses on the month. Now, I should say that, of course, the previous month, it was dreadfully low. So I'm not sure that's a great base to begin with. But Krishna Mamani, I want your view on that. How much weight you'd put on something like the NFIB Small Business Survey? How much weight you'd put on the Senior Loan Officer Opinion Survey we got yesterday afternoon?
Well, so, if you kind of think back on things, nobody would have cared much about the SLOOS survey except for the banking crisis that we are having. So let's be clear about one thing. There's more credit allocation that happens in the corporate bond market than happens through banks, especially regional banks. So I think relying on that too much is probably not the right thing. I would be far more worried about the outlook if credit spreads were blowing out, and you see no sign of that. So I think people are pessimistic, rightly so. Inflation experience has been quite painful for a lot of people, but I don't think you see anything in the data that indicates that there is a recession imminent, whether it's employment, consumption, even construction, housing. If housing can't come down, how do you get a recession?
Are you suggesting then that rates need to go higher, Krishna?
Well, rates are quite high. We have raised rates 500 basis points. I think what I'm suggesting is the Fed has done has made the right call, which is pause and let's wait. And if things are probably going to slow down, but they won't get into recessionary territory. And I think their pausing and extended pause at current levels will probably end up being the right decision.
Seema, ultimately, I sense from you that you believe all roads lead to an equity market that's lower from here, regardless of whether this Fed needs to cut on bad news or hold because the data's good.
Yeah, exactly. Look, it's a fairly nuanced position at the moment. We don't have an imminent recession. We have a recession which is a little bit further down the road. We have a market, an economy which looks very strong. Inflation is sticky. It's still elevated. It's coming down. Now, with the Fed, it seems likely to have paused, but actually I wouldn't take off another 25 basis point off the table. I think it would be a policy error. But given how data dependent they are, and given the strength of this labor market data today, I think there is still a possibility that there will be one more hike come June, or maybe a little bit later down the line in a couple of months. Either way, both of those situations don't look very promising for equity markets.
Krishna, you talk about the pain trade being higher. Can you tell me, is that a tactical call? Over what time horizon are you thinking about that call?
Oh, well, 100%. And it is more a reflection of the pessimism in the market far more than any economic driver. I think at the core level, we are in a range-bound market. And if we get to 4,500 or something close to that, 4,500 is a number that I pulled out of the air. But if we get there, we probably won't stay there for too long.
Seema Shah, Krishna Mamani, they're going to be sticking with us. Looking at an equity market right now on the S&P 500, there's negative 0.5%. Let's get you some movers. We can do that with Abby. Morning, Abby.
Good morning, John. And let's take a look at some shares that are popping sharply higher. And one of them is Palantir. The data analysis company has highlighted unprecedented demand for its AI tools. They also beat, but they're providing limited visibility into the guidance. So some analysts are actually a little bit wary there. Novavax, the fiscal year forecast is better than estimated. They've unveiled some positive vaccine data in addition. They've also talked about cutting 25% of their workforce. Those shares soaring up 27%. PayPal Holdings to the other side down 7.3%. Their first quarter beat, but the second quarter guide is lackluster, especially operating margins. And then finally, speaking of lackluster, Lucid Group, their first quarter revenue numbers missed. Their guide to the low end of the production plan highlights a sluggish start of the year. That stock is also down by about 10%, John.
Abby, thank you. Coming up on this program, the regionals back under pressure.
You look at the loan growth, John, last year in the second half of 2022, it was double digits for the banking industry. We're forecasting this year we'll probably get 3 to 4% loan growth. So lending less is a very fair statement.
PacWest leading the regional banks lower ahead of the opening bout. That conversation up next.
Many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from and where has it gone? Because right now it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Banks are in the business to lend, as we all know, and now they risk adjust that lending, and they may charge more for loans today, but they're not packing up their bags and not lending. They really have if they have real opportunities that on a risk-adjusted basis, it makes sense to lend, they will lend.
From double-digit gains back to double-digit losses, PacWest failing to hold on to that rebound rally and dragging the regionals down with it. The Fed's senior loan officer survey doing little to stem those concerns, signalling tougher lending conditions and falling demand. Your team coverage starts right now with Bloomberg's Katie Lyons in D.C. alongside Sonali Basak here in New York. Sonali, what did we learn from the so-called slews yesterday?
Well, we know that tightening has been occurring for quarters here, John. It was really the middle to the end of last year where it began, and what we know is the rate of change here is pretty normal in the wake of Silicon Valley Bank's failure. Now, when we take a look at this, yes, it is tightening pretty meaningfully. However, we're also taking a look at demand falling pretty dramatically as well. Over at Jefferies, they are seeing that CRE demand was the lowest ever in their data set going back to 1995. This is commercial real estate loans, and the largest drop-off there is in multifamily homes. There is also tightening standards within different categories. Non-farm, residential, and construction loans remaining the tightest category when you look at overall demand for loans. So you are seeing people not really wanting loans as well. There's a little more data here that I think is worth looking at, not just the slews, but also the small business survey that came out this morning. It shows you a lack of serious fear that we have been hearing for weeks and weeks and weeks. Only 2% of business owners said that their borrowing needs were not satisfied, whereas only about a fourth said they were paying a higher rate on their most recent loan. We were expecting refinancings to start to take hold. The thing is, what's the tail here? How long does this go on for as we look towards an eventual end of this tightening cycle? But yes, tighter lending cycles, nothing too crazy here, and conflicting data when you look at the different sources as well.
This time yesterday, we were looking for a bounce in PacWest. Katie Lyons, no bounce at all. It faded going into the close, and this morning, what are we down? About 8%?
Yeah, a little more than 8% in pre-market right now, John. And as you say, yesterday, when we attempted to continue the rally of Friday, it really didn't last very long. After opening 30% higher when the bell rang on Monday morning, PacWest only ended the day 3.7% higher, and it's undoing all of that this morning with this loss of now roughly 8%. That's bleeding through to some of these other regional banks as well, the likes of Western Alliance down 3.2%, Zions and Comerica under some pressure as well, really just building on the pressure we already have seen this year. Remember, PacWest remains down more than 70% year to date. Western Alliance and Zions have each lost more than half of their value, and a lot of the concerns that really drove that move haven't necessarily fully evaporated, John. Concerns around lending, which Sonali was just speaking to, funding costs, just the flow of deposits in the economy right now. And then, of course, there remains a lot of regulatory questions unanswered as well. Now, yes, there may be other factors at play here, short sellers, short squeezes, perhaps exacerbating the size of some of the moves we have seen, but add it all up, and what it contributes to is just higher volatility among the regional banks. Of course, we saw a big uptick in volatility in March with the initial failures of Silicon Valley Bank and Signature. Things calmed down in April, but have picked back up in the last few weeks as, of course, we have added another bank failure to the list, John.
Kaylee, thanks for that. Great work as always. Sonali Basak, Katie Lyons. Let's get to that board again. Year to date, the regionals. Look at this damage. Just sit on those numbers. PacWest, down 74%. Western Alliance, we've chopped it in half, down 54%. And a good chunk of this has come in the last couple of months. Just over the last 2 months, Zion's down about 50%, Comerica down about 46%. And then listen to this from Mike Gapin and the team at Bank of America. Bank behavior did not appear to change following the emergence of regional bank stress. Seema Sharp, can you put those two things together for me? When you look at moves like that year to date, the Senior Loan Officer Opinion Survey, was that as bad as you expected it to be?
Well, I think it's difficult to answer that because Powell had already given us a clear hint of what to expect from this survey. But it wasn't as bad as it could have been, right? Given what we've seen unfold in the last 2 months, maybe we would have expected to see a drastic tightening. This is more of a gentle tightening, a continuation of the trend that was already underway. So we can see that things are not falling off a cliff. This is more of a boiling the frog moment where things are just getting tougher and tougher, maybe without you realizing. The regional banking sector, I think it's got a couple of problems. One of them at the moment, which is why we're seeing stocks so far down, is just there is a lack of confidence. Buyers don't want to get involved in this market at this stage when you have so much hanging over them. And then they have some fundamental problems, which is really that they need to attract deposits in. And unfortunately, they cannot afford to do that. So they're fundamental as well as fit, and together that is creating a very, very tough problem for them.
Seema, what would make you a buyer of this sector? Some of these names on the screen.
You need to see some kind of clear intervention by regulators. some fundamental change in the market coming in from policymakers, not from the fundamentals. That's what we need to see. And at this stage, it looks fairly absent right now.
What would that be, Krishna? A change in deposit insurance? Something else? A rate cut? What would it be?
So let me come at it slightly differently. That is, without talking about specific names, I think regional banks right now are very similar to where home builders were in 2008. That is, the fundamental picture for them is extraordinarily bad because they have a profitability problem, and there's nothing going on that is going to change that in any meaningful way until this cycle ends. So I think talking about FDIC insurance and things like that would certainly help it in the interim, but at the margin. But I don't think it will change the dynamic in a meaningful way. This is a market. This is a sector that is probably trending down and likely to trend down until the whole down trade, if and when it arrives, ends. You know, if you look at home builders. They didn't bottom till March of 2009, which was the bottom of the market. Yeah. And in the interim, first quarter of 2008, they had a massive rally, and people were running around saying that they are back. That's just not the case, and I think it'll be the same situation with the regional banks for some bit.
Well, the home builders have had a nice rally since last June, that's for sure, but we'll put that to one side. Krishna, as you indicated, the home builders problem was our problem back in 2008. The problems with the regionals, are they a problem for all of us now?
Well, so again, the problem with the regionals is all of our problem because it is a Fed tightening problem. That is, deposits grew massively. And as deposits grew, they didn't curtail deposit growth. They took in, as they're supposed to, I suppose, they took in all the deposits. And the assets, on the asset side, the only thing they could buy fast enough were treasuries and mortgage bonds. And then Fed tightened. So now we know where we are. And this is going to be with us for some time.
So why would stocks rally against that backdrop, Krishna?
The stocks are rallying because of short squeeze. That is, when something has come down almost 60, 70% or 50%, you'll have days where things are going to go up a lot. The situation here, however, is if you're a short, yes, you short cover. But do you give up? No. You basically reestablish that short at a higher level.
Seema, we rallied through March, we rallied through April. What do you make of that?
Incredible. I mean, look, it's also, you have to look under the surface. This isn't just, this isn't the broad index really outperforming. These just a couple of handful of names. And that's, I think, a really important takeaway here is from the surface, things look fairly strong. We can talk about market rallying, but under the surface, you can see that concerns are starting to percolate. We do expect that to continue. The bigger question, I think, is really going to be about tech leadership and where is it going to fade sufficiently that the overall index falls and when that happens?
Huge leadership, year to date at least so far. Seema Shah, Krishna Mamali, to the both of you, thank you. Counting it down to the open about 7 minutes away on the S&P 500, shaping up as follows for the equity market. Futures negative through most of this morning. Right now we are negative 0.4%. Coming up the morning calls and later, no room for error. Why better than expected earnings have to tread carefully. That's the view from Clear Harbour's Aaron Kennan. We'll catch up with him around the opening bell. Your opening bell about 7 minutes away.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country? Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Away from the opening bell, equity softer, negative by 0.4%, bouncing around these levels for the last couple of hours. That's the price action. Let's get you some morning calls. First up, Mizuho cutting its Alibaba price target down to 145, expecting consumers to remain cautious due to China's unstable real estate market. That name is down about 3%. Atlantic equities downgrading Shopify to neutral, seeing limited room for further upside after recent gains. We're negative there, almost 1% in the pre-market to 63.75. And finally, Evercore downgrading Cummins to inline, forecasting a notable slowdown and weakness in the U.S. trucking cycle. That name is down 1.4% to 220.52. Coming up, the regional banks resuming their declines after 2 days of gains. That conversation up next with Clear Harbour's Aaron Kennan. About 4 minutes away from the opening bell, with equity futures negative 0.4%, and in the bond market, yields just shifting a little bit higher over the last hour or so, up 2 basis points on a 2-year and back through 4%. From New York, this is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
Japan's critical role in the global economy is changing as the world recalibrates. After decades of stagnation, Japan's leaders are forging a more innovative and sustainable path forward to revitalize the nation. Corporate giants, policymakers, and pioneers tell us how they're doing just that. Every week on Japan Ahead, right here on Bloomberg Television.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Couple of things on the calendar through the next 48 hours or so. Later on this afternoon, 4 p.m. Eastern Time, congressional leaders sitting down in the Oval Office with President Biden. Then on to tomorrow, 8:30 Eastern Time, CPI in America, day after US PPI. Going into all of that, equity futures right now, negative 0.4%. There's your opening bow. Switch on the board and get to the bond market. Yields shaping up as follows on a 10-year, virtually unchanged now. Lower through most of this morning, turning around in the last 30 minutes, the last 60 minutes or so, back to about 351.29 on a 10-year. Unchanged on the session. On a 2-year, yields just bleeding a little bit higher by a couple of basis points and back through 4%. Dollar showing some strength. 109.47 against the euro. We're negative 0.5% on that currency pair. And crude 72.20. We're down about 1.3%. About 20 seconds into the session on the S&P. Negative 0.4% on the S&P 500. On the Nasdaq, softer, lighter, lower, negative by about 0.5%. One stock to watch at the open, PayPal, shares slumping after the company lowered its operating margin forecast. The CFO saying this: "We remain focused on advancing our strategic priorities while operating with discipline in what remains a dynamic environment." Abby, some corporate speak for you to process there.
For sure, there is lots of corporate speak to process there, John. But relative to the stock, down nearly 9%, its worst day in about 14 months, and it has to do everything to do with operating margins. They actually put up what some analysts are calling is a clean quarter for that first quarter, beating, and essentially the outlook even accounts for the beat. But operating margins for the year 2023, they're bringing in by about 25 basis points. So it's interesting. That's not a huge amount, but in terms of what it looks like, analysts, investors not liking it. JP Morgan, though, saying it's more a matter of optics, because if you break down that operating margin to the lower end of the scale, that it has to do with their unbranded checkout. That comes with a lower margin. So it's the dynamic between unbranded checkout and branded checkout that once that is fixed, that it's going to create a better operating margin. On the other hand, Credit Suisse downgrading shares, so it takes two to make a market. This stock stuck in a range between about 70 and 100 over the last year. This report doing nothing to break that range, John.
Stock is down 9%. Abby, thanks for that. Abby mentioned that Credit Suisse downgrade. They downgraded it to neutral after the earnings. This is what the analyst had to say. Given the prospects for continued margin pressures throughout 2023, in an uncertain macro backdrop, along with increasing competitive pressures, we find it challenging to recommend the shares at this time. Not exactly a ringing endorsement, is it? PayPal down by 9.4%. Another stock to watch, Nikola, the EV maker, announcing plans to exit Europe after reporting a wider-than-estimated Q1 loss right in the following. Manufacturing and energy are capital-intensive businesses, and we need to remain focused where we have competitive and first-mover advantages. Ed Ludlow joins us now with more. Morning, Ed.
Yes, good morning, Jonathan. So Iveco will take over full ownership of the European JV. In return, Nikola will receive $35 million, just $35 million in cash, and have 20.6 million of its shares returned. The focus then shifts back to North America, as you said. There is a complete rethink on the strategy and also the outlook for this year. The call is in around an hour's time. We don't yet have any firm guidance, but remember, going into this quarter, Nikola had said it was going to build just 350 trucks this year, split across the battery electric and hydrogen fuel cell. The re-emphasis is shifting to hydrogen, focusing on the fuel cell powered trucks and the hydrogen infrastructure to support them, but we did not get a new range for the year. One important thing to note, though, is that they cited the inventory that they do have for the battery electric truck. They're going to pause production at the Coolidge, Arizona plant and retool it so that it can in the future produce fuel cell trucks more quickly than they had planned. The impact of that pause isn't clear in the context of guidance for this full year. Remember, at its peak, this is a company immediately following its June 2020 listing via SPAC that had a market cap greater than Ford. We're trading at 93 cents for the shares right now, John.
Wow. There were some bubbles out there at that time, but wow. Ed, thank you. That stock is down about 5%. Turning to the retail sector, Under Armour delivering a disappointing outlook as persistent inflation continued eating into margins. The CEO said this: 24 will be a year of building for the brand, positioning us to drive better sales growth in the United States. Kelly Lyons, that name is down by more than 8%.
Yeah, right now on pace for its worst day since last September and at its lowest level since November, John. So a rough day for the stock, now down about 8.5%. After that guidance did come up well short of expectations. Under Armour is forecasting profit of between 47 and 51 cents per share. Even at the high end, that's well short of the 62 cents a share that analysts were looking for. And they're guiding for revenue growth of flat to up slightly. The street was looking for growth of 3.7%. The issue here, John, is one we have become quite familiar with when it comes to retailers, and that is inventory. Inventory in the fiscal fourth quarter rose 44%. Under Armour seems to be having more difficulty than some of its peers in working that down. And what we know is when there's too much supply and not enough demand, that means more promotions, and those discounts do weigh on margins. So the company's new CEO, Stephanie Linnartz, clearly has some work cut out for her. And one analyst over at BMO Capital Markets, in a note after these earnings this morning, is saying the burden of proof now really lies with management execution, John.
Kelly, thank you. Movie recommendation: Air, Ben Affleck, Matt Damon. Very cool for anyone who might want to watch it at a weekend. Kelly, thank you. Let's turn to the financials, away from the sportswear clothing makers. PacWest leading the regional banks lower after a brief respite. The team at Goldman saying this: in the near term, stress remains in the system with concern that weaker equity prices and wider credit spreads could lead to further deposit instability. Shonali Basak, they don't make it sound good, do they?
They don't make it sound good, and the market is following, John. When you look at PacWest shares, not only have they taken a real beating this year, they are trading at 26% of their book value. Banks trading below their book value, we know, are seen as burning money in the market. But when you look at their peers, Western Alliance, Zions, Comerica, all of those banks are trading at almost 60% or more of their book value. So significant differences here. I also want to talk for just a minute, because obviously the stock lower today after just a tiny little bump yesterday. You could see that as short selling in addition to maybe a little bit of stability there. You have the bonds also trading very cheaply, down to 42 cents on the dollar. The bond market volatility has been really significant in these banks. They were trading at 70 cents on the dollar early last week. So when you take a look at it, both the stock market and the bond markets are telling you that they're worried about these banks and where they're going from here, especially as we know, if things were to go really south, both the shareholders and the bondholders are pretty much wiped out in a scenario like that. Now, we're not near that moment. We know that PacWest in particular is exploring strategic options, but those strategic options, as we know, are what put them on a ratings watch over at Fitch. So the strategic direction ahead, until they get it sorted out, it is very hard for both the market as well as other counterparties to get comfortable with what's going on with these banks.
Shonali, this name right now is at 570. Last Monday, it was a double-digit name at $10. In early February, it was trading close to 30. At what phase of this process, Shonali, are we in right now for names like this one?
Yeah, it's really hard to know. It was a lot clearer for the first set of banks, wasn't it? We knew that the pain came fast and hard. But even with deposits showing to stabilize at some of these firms, these longer bleeding existential problems, and you see it. By the way, you want to hear, John, just how negative the banking system, the markets are on the banking system? Only 2 stocks in the KBW index are up on the year. So every other stock is in the red here. It's hard to get them out of that hole, especially when you're looking at a KeyCorp, Zions, Western Alliance, all have different exposures to the market, some of which, whether you're looking at auto loans or commercial real estate, the market is still worried about.
These names trading lower in the first 8 minutes of the session. Shonali, thank you. They had been trading lower through the whole of this morning in the pre-market. Clear Harbour's Aaron Kennard seeing more pain as the banks try to resolve their issues running this. The medicine may have a bitter taste. In order to reduce risk, banks are poised to tighten lending standards in the coming months, further reducing credit availability. This is hardly good news for an economy already teetering on the edge of recession. Aaron, I'm pleased to say, joined us right now. Aaron, here's the problem. The stock market's up on the year on the NASDAQ by something like 10% plus. On the S&P 500, approaching double-digit gains for the year. Aaron, what's going right?
Well, you know, the earnings season that we just, essentially have almost completely completed has looked okay. Estimates were about for 7 to 8% year-over-year decline in earnings, and they came in at -3. And so the market has no reason to shudder on the heels of that news. The employment numbers remain really strong. The consumer looks strong, and inflation is decelerating. And so the narrative that we're going to certainly experience a hard landing isn't really cooked into the book, certainly on the equity side. I think the bonds side is, with the MOVE index, the volatility index for bonds still very elevated, and frankly, yields well below those levels seen in early March would suggest that the bond market is almost a little more concerned than the equity market about the prospects of a recession and perhaps the fallout from banks.
Let's talk about both those pieces. On earnings, Savita Subramanian of Bank of America said something similar. Q1 is tracking a 5% EPS beat. Surprise ratios well above the average. Guidance is pretty strong. On stocks, Aaron, this is something that Krishna Mamani of Lafayette said about 20 minutes ago. He said, we live in a high nominal GDP world. That's not going to change in a material way in the coming months and quarters. He thinks the pain trade for equities is still higher. Any pushback against that?
Well, when you're trading at 19 times earnings and you have unemployment that is perhaps the lowest that we're going to see in this cycle, you have the Fed on hold, but perhaps raising again. It just seems as though the risk reward, and that's what we're always thinking about, of higher equities from here is not all that compelling. And so I think that there is when you look at the data, you look at net long positions, you look at sentiment indicators, they are low. So I think Krishna has a good point that, we're sort of climbing this wall of worry, but earnings growth is not accelerating. And so you'd be buying in at higher multiples if you continue to trade this up to that sort of 4,500 level from where we are right now.
And that disconnect that you identified between the bond market, the Fed, and the equity market, Marko Kolanovic at JP Morgan thinks that reconciles, closes at the expense of equities. Is that something that resonates with you then?
Well, it certainly feels that way. And I say that because, the good news is employment's remained strong. The consumer on the margin has remained strong, although we're seeing some signs of cracking when you look at, the rise in credit card rates and the rise in revolving lines of credit, the delinquencies on the auto loan front. But those chickens may not come home to roost until maybe later this year rather than earlier. And so the Fed may not cut until the latter part of this year, maybe the fourth quarter into early 2024. History would suggest markets do not bottom until the Fed cuts after a tightening cycle. And so I think perhaps my friend over at JP Morgan has a point.
This is something we discussed on the program just yesterday. Can you really price in the recovery to a recession we haven't had yet?
Yeah, I mean, I think that's a challenge. The average cycle would suggest that there's odds of a 12.5% recession, 12.5% odds of a recession every year, because we have a recession once every, call it 8 years. So even if you think there's a sort of 3 times the likelihood of a recession this year, it still suggests that, the odds are we don't have one. And so that's why we're sort of in the soft landing camp. I mean, our debt to GDP levels are high. Fiscal stimulus is coming off from the COVID period somewhat significantly. We have a debt ceiling debate that is roaring with no real end there in sight. And so the uncertainty factor is rising on that front. I mean, I think that the risks of a recession are certainly more than that 12.5% average level. But are we in a hard landing camp here at Clear Harbor? Not right now at this moment.
I'll spare you the conversation on the debt ceiling debate, Aaron. I like you. Aaron Kennan of Clear Harbor. Aaron, thank you. That conversation's coming up next. Biden and McCarthy meeting face to face.
I will not raise taxes, and we will not pass a clean debt ceiling.
Whether you pay the debt or not doesn't have a damn thing to do with what your budget is.
That drama unfolding at the White House in around about 6 hours' time. We'll get the view from Henrietta Trays of Vader Partners and AMH down in Washington up next.
one covers the world like Bloomberg.
It would be, of course, a total disaster for Emmanuel Macron because he's been elected on this reform and he would have to basically start from scratch.
It definitely is an exciting day for Apple. First store in India, here in downtown Mumbai, a second one coming up in Delhi.
TK, we've got a lot to talk about.
Debt, China, and the shockingly cautious view the IMF has on the view 5 years forward.
Bloomberg, your global business authority.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
We're coming up on a debt limit here in June.
Yes, early June.
No one should assume that the Fed can protect the economy.
But these negotiations should not take place with a gun really to the head of the American people.
The president has ignored this problem. I said, Mr. President, why don't we sit down and work through it?
It's Congress's job to do this.
I will not raise taxes, and we will not pass a clean debt ceiling.
Whether you pay the debt or not doesn't have a damn thing to do with what your budget is.
You know what happens with a compromise? We can get something together.
Let's get it straight. We're trying to hold the debt hostage to us to agree to some draconian cuts.
Debt ceiling drama unfolding in Washington, D.C. President Biden meeting with congressional leaders at 4 p.m. Eastern in the Oval Office, the first step towards cutting a deal to avoid default. The White House insisting on separating budget talks from the debt limit. Speaker McCarthy said on linking spending cuts to any increase in the ceiling. Senate Minority Leader Mitch McConnell telling Bloomberg that he's got, quote, no secret plan to resolve the standstill. Anne-Marie joined us now in D.C. Morning, Anne-Marie.
Good morning, John. Well, you just outlined the status quo in Washington, D.C. going into this high-stakes meeting. But we need to remember, this is probably the first meeting of many if there were to be a negotiation and there was to be a deal before June 1st or in the few weeks in the beginning of June, because Treasury Secretary Janet Yellen says as soon as June 1st, that is potentially when we can have the X date. What you're going to want to know coming out of this meeting is anyone softening these red lines, most notably the White House and, of course, Speaker McCarthy.
AMH, thank you. Much more from Anne-Marie through the day on Bloomberg TV and on Bloomberg Radio. Look out for Balance of Power a little bit later with Joe Matthew, 5 p.m. Eastern Time. Don't expect any major breakthroughs today. That's the view from Henrietta Trey's of Vader Partners. She writes the following. Investors should expect each side to stick to their current talking points with no new ground broken. We're not expecting any material breakthrough on negotiations until late this week at the earliest. Henrietta, I'm pleased to say, joins us right now. Henrietta, thanks for being with us. Let's talk about process before we talk about substance. How much negotiations do you actually think is going to take place a little bit later?
Today, I'm not expecting much of anything. I think both sides will sort of reiterate their point. Press will be available to take pictures. And we've all seen that in the last couple of rounds here, famously seeing former President Trump and Speaker Pelosi going into a room together with Senator Schumer and Senator McConnell. It's basically all the same figures again, just with Biden and Hakeem Jeffries replacing those other two. And I expect it'll just be a lot of handshakes, reiteration of their points. The one thing I'm really watching for is any indication that we're going to start tying this seriously to the federal spending bills. That, most prominently for investors, could be an early indicator that we're going to punt this entire debate into the late September period, which is the end of the federal fiscal year. So I'm encouraging clients to really focus on that narrative. Any mention of appropriations bills, fiscal year 2024, those are all buzzwords for, hey, maybe we just kick the can on this for a couple more months.
Lots of people are telling me it's important that Congress isn't really working this month. You have to pay attention to how little they're going to be around. Henrietta, is that important?
I honestly, I don't think so. They don't vote at the same time anyway. So I think, and in my experience now going back more than a decade, having 3, almost 4 weeks to hammer out a deal is plenty of time. This is all done by staff behind the scenes anyway. This is not something that you bring all of your rank and file members in on. This is a leadership decision, as evidenced by today's meeting. So I'm hoping that staff gets together at a senior level later on this weekend, as early as Thursday, I would say, and starts hashing out what I expect will ultimately be $300 to $500 billion in tolerable spending cuts that would come from clawing back COVID relief aid and things along those lines that can get them to a path where the Senate votes next week, then they go on recess, and then the House votes the following week, and then everybody departs for the Memorial Day break. That's plenty of time, and they don't need to be in office at the same time to vote. They're not in the same chamber anyway.
Reading the tea leaves, follow the staff, is something you told me a number of weeks ago. Henry, I think a lot of people in this market, and I'm happy to speak for them because they talk to me often about it, they're struggling to find an edge. They can't find an edge because they don't really know what to look for in these negotiations. They think it turns out the way it always turns out. It's not going to be different this time. Henrietta, how do you get an edge on how you read these negotiations, the tea leaves you look at, what you follow, and whether you ultimately think it's different this time?
Well, I really stick with the tried and true. I continue to talk with staff every single day. They're the ones who have a temperature on the caucus. They're the ones who understand which Democrats can vote for which alterations, which Republicans would prefer to keep the energy tax incentives. It's really just about connecting the dots to get to 60 votes in the Senate and 218 in the House. And staff is best positioned to do that. So I would encourage your watchers to focus on the moderate Senate Republicans. A couple off the top of my head would be Lisa Murkowski, Senator Susan Collins, Mitt Romney, Tom Tillis. Those are members who are going to take the lead here necessarily because they're the ones who are going to vote for it. There's no scenario where a Lindsey Graham or a Rand Paul votes for a debt ceiling hike. We can see that looking back at their vote history for decades now. And the same holds true on the House side. If you look at the 2014 debate, you had Speaker Boehner, a Republican from Ohio, as the Speaker in a Republican House. And then you had Democrats in the Senate and the White House. It's effectively the same playbook. And if you look at the final vote there, it was something like 23 Republicans and 193 Democrats who ultimately provided the votes for the debt ceiling hike. That's the same thing we're going to see again. And I can point you to many other examples of exactly that same dynamic. Democrats carry the water in the House side. We need 10 to 12 Republicans on the Senate side. So I would just focus on those members.
This is just getting started. I have a feeling we'll be talking on a daily basis very shortly. Henrietta Trey's there at Veda Partners. Henrietta, thank you. Wonderful to catch up with her. One of the best down in Washington. For your equity market, we're down about 0.4%. Let's get you some sector price action. Here's Abby.
John, well, we are looking at this decline for the S&P 500, low volume, but nonetheless, it is broad-based. Most S&P 500 sectors are lower, tend to be precise, led by real estate and materials, both down more than 1%. The one sector that is higher, communication services, up about 0.4%. What's interesting, though, is over the last 5 days, tech, the biggest weighting to the S&P 500, well, it's actually higher. It's not just tech. It is the entire mega cap tech complex, communication services, tech, and discretionary. So go figure.
Abby, thank you. That's the sector price action. Your trading diary up next.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader.
Yes.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
26 minutes into the session, trading just a little bit softer. Let's get straight to the trading diary. Fed speak picking up with Williams at noon Eastern. Then at 4 p.m, President Biden's debt limit meeting with congressional leaders. US CPI out tomorrow morning, PPI the following day, and another round of jobless claims on Thursday, plus the Bank of England's next rate decision. From New York City, that's it for me. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Many people recognize you because you have a very famous hairdo that I've asked you about before. But to some people, they may say, well, Ken, what happened? Where did that hairdo come from and where has it gone? Because right now it seems a little different than what I've seen before.
Yeah, it's growing out a little bit, David, but COVID, you know, I ended up with hair going back down to my shoulder, and I finally realized that one of the things I had to do, I'm a very loyal person, and I used to have hair down to my waist in my college and my hippie days before that in Ann Arbor, Michigan, and I had it cut off in the summer of '75, and I've gone to the same person, now a grandmother many times over, who was a young gal cutting hair in Amherst, Massachusetts, and I still seek her out, and I finally just said to her, you know, COVID's enough of a change that I ought to be able to do something new.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
Fed was going to keep rating World Cup. This is a 3.
As the economic picture does.
The BOK is getting ready to make a decision.
Pepsi's Number Fever campaign in the Philippines
has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sci-Fi stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks.